but I move quickly to my very own senior colleague, member of council, vice council, Mr. Oladele Oladipo FCA. He's a partner of the PwC and a member of the African Council. He has graciously accepted to chair this session, and I'll hand over the organization of the program back to him. He deems it fit to hand it back to me after his speech. So over to you, sir.
Assalamu alaikum wa rahmatullahi ta'ala wa barakatuh. I greet all our fellow thank you. I greet all our fellow Muslim brothers and sisters. Good morning, and you're welcome to this very important session organized by Mpaan. I'd like to start by giving gratitude and all praise due to Almighty Allah subhanahu wa ta'ala, without whom we will not be here today. We also seek Allah's blessings on our noble Prophet Muhammad sallallahu alaihi wasallam, his household, his family, and the rest of us who follow his footsteps until the day of accountability. May Allah make Islam our evidence in our favor and not evidence against us on the day of Al-Jannah. I welcome you all to this program. The chairman of Mpaan has made a speech. There really is nothing more for me to add, but I'd just like to thank everybody for finding time out of their busy schedule to join this program. I would like to thank the organizers. I also like to especially thank our paper presenters who are going to impart in us knowledge which I believe is going to be very useful. As the paper presentation is going on, I'll please, in addition to our members being attentive and not be distracted, please implore you to note any questions or comments that you have, because it's going to be a very robust and engaging session. I know Oga Aziz very well, as I like to call him. He's a very senior colleague and one of those people that we look up to in the profession. I pray that we all gain beneficial knowledge from this session. And as a professional accountant, it's an opportunity for us to continue to develop ourselves. As the president has said earlier on, the cornerstone of Islam, the cornerstone of being a Muslim is about seeking knowledge. And it's not just knowledge about this world or the hereafter, even knowledge of of our daily bread, of how to survive economically, physically, spiritually. All those are things that make one a complete Muslim. So to that extent, I will please implore everybody to be very attentive, to be very productive. We have a long way ahead of us, but I believe that if we discipline with our time and we pay rapt attention to the sessions as they go on, we can't even be able to finish this even in faster time. So please, brothers and sisters, I once again appreciate you for joining. And by the mercy of Allah, we will all be very enriched at the end of this program. Thank you, Mr. MC. Assalamu alaikum wa rahmatullahi wa barakatuh.
Thank you very much, sir. I continue to protect and elevate your status. I'll hand over. So I'm not here alone. I'm not the only person moderating the session. I have me, my respected Ajia Wasila online Raju FCPA, who is also moderating today's session with me. And I will hand over to her right away to please introduce the first speaker for today and the words of the chairman of GAVIS. So Ajia Wasila, over to you. Ajia Wasila, you can see. Okay.
So sorry, the network. I hope you can hear me, please.
All right. Yes, we can hear you now. We can see you.
Please, can you hear me, please? Is the network? I'm so sorry.
Yes.
Can you give me permission to just share my screen so that I'll be able to? Okay, fine. I've been able to see. Thank you. All right. Assalamu alaikum warahmatullahi wabarakatuh. Once again, you're welcome to the Mpaan Quaterly seminar. And as the president just seminar to improve our knowledge, and as my colleague said, my name is Wasila Tanaiwa. I'll be introducing the first facilitator for today is our father. And I remember that when I got inducted for CITN, his lecture was one of the people that made it easy for us to say that, okay, yes, if you want to go into taxation is something that we would love to and willingly want to go into. So let me quickly, without wasting time, let me quickly introduce him. Is Alhaji Aziz Atole is the managing partner of Assertion Consulting Services. He provides support for business development, operational excellence, and practice management of the firm. He is the fellow of the Institute of Chartered Accountants of Nigeria. He is the fellow of Chartered Institute of Taxation of Nigeria. He is a barrister and solicitor of the Supreme Court of Nigeria and member of the Nigerian Government. He is the fellow of the Institute of Chartered Institute of Arbitrators UK, of Bradford, UK. He also had his HND from Kwara State Polytechnic. So he has worked with SO Saya, Pricewaterhouse, Hakim Tola Williams, and Deloitte, S.I. Young, several professional services, prior to commencing his own Assertion Consulting Services on August College, skills and experience in fiscal national tax, business tax compliance, direct taxes. He's a member of the tax faculty, he's a member of the technical committee to 2018, and a key member of the fiscal team, somebody that is more than well loaded in this tax. Welcome, sir. We look for the thank you, sir.
All right, I apologize on behalf of Ms. Wasila for the network, and I apologize on behalf of the network provider as well. Raja, over to you, sir, and we'll be on to you for the next 90 minutes. Please let's get papers and writing parts. Over to you, sir.
All right. Jazakumullah khairan jaza. Firstly, let me say assalamu alaikum wa rahmatullahi ta'ala wa barakatuhu.
Wa alaikum assalam wa rahmatullahi.
With the permission of the chairman, let me share my paper, and then I start, fully and properly. Okay. Okay. Are you seeing my paper at that side?
Yes, sir. We can see your screen, sir.
All right. Okay. So, all right. Okay, yeah, thanks very much. The chairman of Mpaan, our dear brother Adelu Motiu, the chairman of the session, my very good brother Oladele Oladipo FCA and council member, the coordinator, brother Ahmed Sanusi, my co-paper presenter, all protocols duly observed. all distinguished participants in this session. I greet us all. Assalamu alaikum wa rahmatullahi ta'ala wa barakatuh once again. I have been directed or asked to discuss on deferred tax computation and analysis for the benefits of Mpaan members and all attendees. So when I saw the arrangement of the program that Mr. Oladipo is going to chair the session, I said that you brought a council member to chair this program and is in the best position to actually have done better on this topic. But notwithstanding, I would try my best. Let me also recognize some people who are experts on this subject matter. Otumba Abdurrahman Nafalabi, also, I know he's very versatile on this topic. So if there are anything I've missed out, I believe I have people at the back who are definitely going to cover, you know, those gaps. So the presentation is going to be an hour, and the other part is going to be questions and answers for the benefit of our members. So at the end of the session, there are some learning outcomes which I think we will be taking away. And the first of it is overview of deferred tax generally. This overview is very important because I have had a very serious challenge with our members, members of ICANN, not necessarily Muslims, up to the extent of threat of arrest, you know, and all those kind of things for non-payment of deferred tax that is in the financial statement. I will get to that a little bit. So I think it is very good for us all to understand what deferred tax is and its treatment from financial statement perspective, and also from taxation perspective, not only from financial statement perspective, because I think that is where the challenge was in the past. I will give a little bit more details about that when I get to introduction. The second one is influencing factors of deferred tax, for us to note what can cause deferred tax and what is a permanent difference that may not cause a deferred tax. The third thing is some practical analysis of those tax computations and then case studies. So we've come up with about 7 different scenarios to have a look at. Those are not all the scenarios. Of course, you know, IFRS 12, you know, that deals with, or IAS 12, that deals with deferred tax, has almost, I think, about 42 pages or thereabouts. So we can only extract some scenarios. So I would still suggest that we all go back to those details and read them and be very, very conversant, you know, with those details. And finally, which also interests me most, is the strategic consideration in deferred tax planning. How do you use deferred tax planning in your organization or as consultants to be able to add value, you know, to our clients? And I think that area has to do with the commercial aspects of the technical applications. It is insufficient to know accounting and to know tax and for you not to benefit from it. One of the things that, you know, we can benefit from is how can we use deferred tax to advise our clients, those of us who are consultants, and be able to make some savings for them. Some could be huge savings depending on the size of the organization and the size of transactions. And if we are in organizations, if we identify transfer pricing, deferred tax opportunities, how do we raise it with our management, call the consultant, you look into it and say, oh, we are going to make these savings, our tax savings, you know, within the confines of the law, and which is very legitimate. So, and how do you raise that issue? And I believe if we are able to raise that as Muslims, definitely it's going to improve on our KPI. So that has to do significantly on how we can add value to our organizations and then be able to make savings for our companies. So we will be looking at the introduction. We will also be looking at definition of key terminologies. What is deferred tax, as I have said, factors influencing deferred tax computations, practical analysis, and some case studies, then strategic consideration. And then we will be drawing a conclusion. Then from there, we do questions and answer. So I'm going to start with introduction. So the first thing about deferred tax is that the amount of income tax payable in any particular tax year, that is year of assessment, does not necessarily have the same relationship with the income tax reported in the statement of profit and loss and other comprehensive income. This first sentence was the major challenge which I faced on deferred tax provisions in the financial statement. And let me explain a little bit this statement, and then I tell you the challenge I faced because of the time, and I'm going to be very brief about that. Now, we have said here that the amount of income tax payable in any particular year, let's say 2023, which was last year, the provision that is made in the 2022 financial statement, for example, does not necessarily have to be or have the same relationship with the income tax reported in the financial statement. Let me put it that way, in the profit and loss account. So the tax payable is one aspect based on the income tax computation, the liability that you arrive at that is payable to the government. Let me use the FRS, for example. Now, that tax liability is only one which is payable. Then the other one you need to do is your deferred tax provision. So if you have a deferred tax liability that you provide, that the company has to provide for, you have to add it to the tax payable to the government. And it is the two that you add together that you have to provide for in your financial statement. You can see that the two are different. You might have a tax computation of, let's say, 200 million naira payable. But you might have asset that is worth billion. And when you now compute, the VAT tax provision, on that, because you are claiming some tax benefit now for which you're not going to be having capital allowances to match in the future. Now, if you made a deferred tax provision of, let's say, 400 million, it's even bigger than the 200 million, which is the current year tax liability, based on some reliefs you have claimed. Now, your total provision in the financial statement is going to be like 600 million, which is 200 plus 400, 600 million provision. So in that year, you just pay, in 2023, based on 2022 account, you just pay 200 million to the government. Now, the problem I had on this issue was I have one client that was a German, company, and did normal tax computation and also did deferred tax provision, like this 600 million I've given the example. And so one of our members, who is a fellow chartered accountant appointed by the Senate, had to do the audit of the company, and came up that, yes, the company was compliant as far as the CIT is concerned, but they failed to remit deferred tax to the government, which is about 400 million or thereabouts. And so we have to be summoned to the Senate and ask why, the company did not remit the 400 million, to the government. And I was shocked. So we all sat down, at the chambers there. And I was like, who advised you that deferred tax is payable to the government? And they said it's the consultant, pointed at him and said he's a fellow chartered accountant. And I said, my brother, I think I'm not hearing this thing very well. Really, is deferred tax payable to FRS? He said yes, because it's already been provided for in the accounts. The company is just holding it back and it's not being paid to the government. And I was shocked. I said, I called his name, so I'm going to keep that off track, that I'm going to petition, ICANN to withdraw your certificate. If you are telling us in this house that the deferred tax is payable, what is payable has already been paid. And the deferred tax is not a payable, transaction. You're only providing for it to regulate, your dividend, your profit in the accounts. Well, the chairman of the session threatened that, okay, Mr. Lati, we can order your arrest, for aiding and abetting. And I was getting shocked. I said, okay, if you want to order an arrest, please go ahead and do that. The temperament started going up, and I was like, deferred tax payable by a fellow, I'm shocked, So anyway, one of the honorable from Oyo State, who is also a chartered accountant, went and spoke to the chairman. So the temple calmed down. He said, okay, if you can allow him to be the chairman of the session, another one. So we have to go back again. At that time, he then called me. The chairman himself, who threatened to arrest, then called me and said, okay, now it has been explained to me. I think there was a mix-up. I said, well, anyway, we were able to resolve the matter. So this sentence that is number 1 on the introduction here, I want us all to please pay attention to it. And anywhere we want to do our presentation or discussion on deferred tax, I think we need to make it very clear to our members that deferred tax provision in the accounts is not a payable amount to the FIRS. It's just to regulate, your tax going forward, where you need to make provision so that you can have an accounting provision for the payment of such taxes going forward in future. Now, the next issue is that the main reason is the fact that income tax payable by an entity is guided by the provisions in the extant tax laws, while the income tax reports in the PLOSI may have impact of deferred tax that is based on the principles in the accounting standards, i.e. the IFRS. So we can see the two. The tax payable is based on the tax law, period. The tax provision is based on IFRS, which includes the tax payable under the law as well as the deferred tax provision under IAS 12 in line with the IFRS. So when you add the two together is when you are going to have your deferred tax provision. I know this may sound very elementary to quite a lot of fellows on this platform, but if you encounter the like of my friend that we later became friend, then you might be surprised that, oh, what we think to be basic is not that basic. So in making this provision, as I said earlier on, we will look at where our members need to look at the advantages of making deferred tax provision and deferred tax asset and how to benefit from it in the tax planning within the provisions of the law. So I said, hence, to account for the tax effect of all accounting transactions in the given tax period, deferred tax provision is necessary, and the accounting standard guiding the subject matter is the IAS 12, which is on income tax. All right, so we have the accounting standard that is guiding the provision for deferred tax. All right, so the second aspect of the technical discussion is some key terminologies. And I won't spend much time on this because I believe we are all accountants and we can go back and look at it in much more details. So the first one is accounting profit, which is different from tax profit. You know, whatever we have in our P&L or PLOSI is different from what we are going to have as the taxable profit. So accounting profit is the net profit or loss of a company for a period before deducting the tax expense. You know, when we have the profit before tax, that's what we mean by accounting profit. That's going to be the basis upon which you say, okay, profit, you know, as per the financial statement, before you then pass all necessary adjustments before you arrive at the taxable profit or at the tax loss. So taxable profit is the profit or loss for a period determined in accordance with the rules legally established by the taxation authorities upon which income taxes are payable or recoverable as the case may be. That's when you have a refund. So what we are saying is that the tax profit is basically determined by the law, not by the accounting rules. And of course, if an expense is allowed in accounting, that expense will only be allowable for tax purposes to the extent that the tax law allows it. Let me be a little bit step forward. Now, if you look at expenses that are allowable in accounting, generally, whatever those expenses are, includes the actual expense, it includes accruals, it includes provisions. All these provisions, they are all allowable. And it includes all unallowable expenses for tax purposes. So all these expenses are allowable in arriving at the taxable profit. But what is allowable for tax purposes is only in section 24. And what is not allowable is in section 27 of the Companies Income Tax Act, when we pick a limited liability company, you know, for example. So that section is going to say that all outgoing expenses are allowable, but there are rules. They will be subjected to the REN rules. They must be wholly, they must be reasonably, they must be exclusively, and they must be necessarily incurred for generating the profit of that year of assessment, of that period. That's what you have there. So what that means is an expense, any of those expense that doesn't fulfill those REN rule will definitely be allowable for accounting purposes, but will not be allowable for tax purposes. Another one is the asset that is being used for generating, you know, that income. What you use actually is, for accounting purposes, is depreciation. But depreciation is a provision, and provisions are not allowable in tax. So in lieu of that, what you're going to have is the capital allowance. But this capital allowance is not also to be charged in the profit and loss account. So if you look at it very well, you have accounting profit that goes by the IFRS rule from beginning to the end. And then you have the tax profit that goes by the company's Income Tax Act. That is what governs it. So all those expenses that are liable under IFRS, they are going to be subject to section 24 and 27 of the Company's Income Tax as amended. When I say as amended, by all various finance acts, finance miscellaneous provision acts that have not been put, you know, directly into the LFN. So that is what governs the taxable profit, and we need to know that very well. Now, tax expense. Tax expense are those expense that you charge, which I just explained a while ago now, is the aggregate amount of allowable expenses included in the determination of net profit or loss for the period in respect of current tax and deferred tax. So those expenses that you charge and that are allowable, just as what we call OPEX under PLOC, is what you call tax expense when you are doing the tax competition. And then finally on this slide is the current tax, which was the one I had an issue with in my earlier discussion, is the amount of income tax payable or recoverable in respect of the tax profit or tax loss for a period. For instance, I did use 2023, which was the immediate last year, as the current tax. The current tax for 2023 in the scenario I gave earlier was 200 million, tax liability payable to the government. So, and that 200 million alone is what is referred to, as the tax, payable. But when you add the deferred tax of 400 million to it, so you have the deferred tax of 400 million, you have the total tax provision of 600 million. All right, so let's go further on some other terminologies that will be very helpful. Temporary difference. And that is the major basis for deferred tax calculation, whether it's deferred tax liability or it is deferred tax asset, because those are the two. Or you have some scenarios that are not going to lead to deferred tax because they are going to be of permanent difference. No permanent difference leads to deferred tax. So what leads to deferred tax is temporary difference that leads to deferred tax. And the deferred tax will be deferred tax liability or deferred tax asset. So let's look at those temporary differences. Temporary differences are differences between the carrying amount of an asset or liability in the balance sheet and its tax base. For instance, you will have, if we use asset, for example, you have an asset, which we will look at the example very shortly. You have an asset you bought for 1,000 naira. Your depreciation over 5 years is 200. You remove that, you get 800. But if your capital allowance claimable in that year is 25%, then that's going to be 250 as against 200. So you can see the balance carry forward as per account is going to be 800, whereas the balance carry forward by tax is going to be 750. So you can see there is a difference of 50. What that means is that in future, you will be claiming depreciation of 50, for which there is not going to be a capital allowance for you to claim. So that leads to a temporary difference. The reason why it is a temporary difference is that on the overall, what you can claim, the maximum you can claim is 1,000 naira. You can't claim more than that. Whether you claim it over 4 years under the capital allowances rule of 25%, or you claim it 5 years at the rate of 20%, at the last year, everything is going to summarize. So, and that is why it is referred to as temporary differences. So there are differences between the carrying amount of an asset or liability in the balance sheet and its tax base. The balance sheet is for the financial statements. Merely looking at the financial statement where the position is 20%, you will see 800, whether it's 800 million, 800,000, whatever it is, you see that, okay, 20% of this has correctly been taken. And of course, it's going to be certified by the auditors and sign off to say, okay, it's 800. So that is correct. Meanwhile, if you go to the tax base for the future, if you pick your tax computation, for example, you will see the same 1,000 for which 250 has been claimed as capital allowance. So you will see tax written down value carry forward of 750. So you can see for the same year, you have 800 in the financial statement, you have the tax-based claimable going forward of 750. So temporary differences may either be, taxable and deductible temporary differences. So it may be taxable, differences that you need to carry forward. Now let's look at taxable temporary differences and deductible temporary differences. Taxable temporary differences are differences that will result in taxable amounts in determining the taxable profit or tax loss of future periods when the carrying amount of the asset or liability is recovered or settled. Whereas deductible temporary differences are temporary differences that will result in amounts that are deductible in determining, a taxable profit of future periods when the carrying amount of the asset or liability is recovered or is settled. Let's use gratuity, for example. If you make provision for gratuity now, it's not going to be allowed for tax purposes if it is provision. But anytime you pay that gratuity, you're not going to, you are going to allow it for tax purposes, but you won't be able to charge it again for the accounting purpose because you already provided for it. So you can see a timing difference. Now you are making provision, it's not allowable for tax purposes, and it's not deductible for tax purposes. But in future, it's going to be deductible, but then you are not going to charge it to the financial statement again. So now what I have explained creates time, that is timing differences. There are differences between taxable profit and accounting profit that originate in one period and reverse in one or more subsequent periods. Like that capital allowance that I have given is going to be reversing, the differences are going to be over like a period of 4 or 5 years. And such differences originate in one period and are expected to reverse in one or more subsequent periods. While all timing differences are temporary difference, not all temporary differences are timing differences. So let's look at the deferred tax liability. They are the amounts of income tax payable in future periods in respect of taxable temporary differences. I've given us how an asset claim, is going to lead to a deferred tax liability, for example. When you made more claim of capital allowances, in future you are going to be disallowing depreciation. You are going to pay tax on it. So what is a timing difference because you've already made a claim, in the prior years, and you made a claim of capital allowances of more than depreciation that you have made. So your tax is going to be reduced now, but you are going to be paying more taxes, going forward. And that's where the planning also, comes in that I spoke about. Now, deferred tax assets, they are the amount of income tax recoverable in future periods in respect of deductible, temporary differences and record of unused tax losses, and they carry forward, use the tax credits. Sometimes you have a tax credits that are not being utilized. You use it in future, you don't have any liability right now. For instance, you have a tax credit of 1 million naira in your accounts. So what that means is that after payment of all taxes, you don't have any outstanding whatsoever. So this 1 million naira is going to be a tax asset. It's going to lead to a deferred tax asset for which you are going to use to set off your tax liability going forward. So it is really a tax asset, for you.
So the
tax base of an asset or
liability.
liability.
Sorry, can all
I think there is an interruption
listeners
somewhere
please
there.
mute Hamid Odumaye. Okay.
Yes.
Sorry, guys, go ahead, sir.
No problem. Thanks, Dele. Thanks. So you have the tax base of an asset or liability. Is the same thing with the second one, except that this puts together both asset and liability, which is the amount attributed to that asset or liability for tax purposes. You significantly find out these figures in what is called probably tax balance sheet or the carry forward or tax written down value that you have, carry forward as against what you have in the financial statement. And it's further broken down that the tax base of an asset is the amount that will be deductible for tax purposes in future periods, which is the example I gave. So example of taxable difference, a higher carrying amount of plant and equipment compared to tax written down value as a result of accelerated capital allowances. So where you have the PPE as well as the TWDV, you compare the two, and then you see that there is a timing difference for the future, whichever one is higher. And we will see an example as we move on. Example of deductible difference, provisions disallowed for tax purposes until payment is made, e.g. gratuity, which I also mentioned. So what is deferred tax as far as definition is concerned now? Is the tax consequence or consequences of the future recovery or settlement of temporary differences between the carrying amount of assets or liabilities in a company's statement of financial position and its tax base if it is probable that recovery or settlement of that temporary differences will make future tax payments larger or smaller than they would have been if such recovery or settlement of the temporary differences were to have no tax consequences. So deferred tax here, this definition can be broken down, into two. Some are talking about the deferred tax provision that needs to be made, while some are talking to deferred tax assets that also need to be looked into. So there are two methods of deferred tax calculation, and the description above perfectly aligned to liability or balance sheet method that uses temporary differences. Meanwhile, the profit or loss method of deferred calculation uses timing differences for its deferred tax determination. Since all timing differences are temporary differences, but not all temporary differences are timing differences, are timing in nature, hence deferred tax computation now aligned to liability method, which is balance sheet method. To simplify it, if we go by balance sheet method, it's going to be much easier. You look at the balances you have in your statement of financial position, as well as your tax base, and then compare the two. You can easily see the deferred tax that you have. So there are 5 key points, from the earlier submissions that has been made. This is just like a summary of all that we have been discussing. The first one is that deferred tax is created when there is a delay in recognition of actual tax impacts or financial activities when they occur due to application of tax rules. So that's number 1 point, which we have picked from what has been said earlier on. This may cause a difference between accounting profit, that's PLOSI, and the taxable profit in the tax-based records, and by extension, a difference between the carrying amount in the SOFP, that's Statement of Financial Position, and their tax base, i.e. corresponding tax records. These differences could be temporary or permanent. However, permanent differences do not have deferred tax impact. Let me give us a permanent difference. For instance, if you pay fine, penalty to the government, if you pay that, and the fine and penalty you are paying is for this year and for next year, for example, whichever period you pay penalty for, penalty is not going to be allowable under tax law. It's not allowable because it's a fine for an offense. So it's just going to lead to a permanent difference, not something that you say, okay, it's going to be allowed for tax purposes. It will never be in the tax base that you can claim in future. And that's very simple, straightforward. So anything very similar like that, as you know, oh, we charge it to this year, it's not going to be allowable. You can't start splitting that I allow it this year, it's going to set off. It's going to lead to a permanent difference. And we'll see a number of those items. So through the computation of deferred tax, the accounting standard seeks to match timing of recognition of tax expense with timing of recognition of the financial activities, which is the key point I've mentioned earlier on, that what leads to the timing difference is significantly the differences between the accounting claims as allowable in PLUSI and the tax claims as allowable under Section 2427 of the Companies Income Tax Act. Therefore, accounting standard, that is IAS 12, demands that the future tax liabilities and assets, or assets as the case may be, that are taxable or recoverable through these financial activities must be properly accounted for in the same year. For instance, these future tax accruals are called deferred tax liability. That's when you make provision for them. Like all accruals, deferred tax liability will be reversed, when the actual tax crystallizes in future. All right, so let's look at some factors influencing deferred tax assets. Those things that lead to deferred tax, rather, not really assets, that leads to deferred tax. The first one is accelerated capital allowance. I've given an example of an asset of 1,000 naira, and we also see that. I try to be consistent with that so that at least we will remember very easily without necessarily looking at the slide. Okay, if you claim depreciation of 20%, and then you are claiming capital allowances on motor vehicle, for example, is 25%. So you're going to have that difference. And that's going to be temporary because we still claim with depreciation over the same amount and then capital allowances over the same amount, but over a different period of time. So apply that principle to all others generally. You will see, how timing differences, arise on each of these items. Let's look at unutilized, capital allowance. Accelerated capital allowance is where, for instance, I did mention motor vehicle and some other asset like that, where you have 50% capital allowance, initial allowance, and then you also have 25% annual allowance. If you add that together, that's almost 62.5% in the first year, of that asset. So basically what you are going to be carrying forward is going to be very small compared with what you have charged in the first year. So that's going to lead to a timing difference, because if your depreciation rate is just only 20%, you are claiming 20% against 62.5%, you are claiming in your tax calculation. So that's going to be an accelerated, capital allowance. In fact, there is an aggressive one where you have, almost 95%, claimable in the first year. So you just be claiming, depreciation over the other years, whereas the law allows you to claim almost 95% you keep, or 90% as the case may be, depending on what the federal government want to encourage in those industries, like gas, for example. You have a very huge claim of capital allowances in the first year, whereas you don't have so much tax written down value going forward. That's what is referred to as accelerated capital allowance, for which you will be charging depreciation as you move on, but there will be no capital allowance. Now, let's move to the second one, which is unutilized capital allowance. If you charge about 90% of the value of asset in year one, are you likely going to have profit to write off all those 90%? Not likely. It's, in the earlier years of operations, you don't have that level of revenue. So you're likely going to have unutilized capital allowances, carry forward. Out of the, 90% that the law allows you, probably you will be able to claim 50%, 40%, 50% of that. So you still have carry forward capital allowance, even though the law allows you to claim it, but you don't have that revenue. This is just an incentive to taxpayers to say, come to this industry. We are going to allow you to claim, your tax expense, even though your accounting rule is not allowing you based on IFRS or IAS, you are not allowed to, claim more than, 20% based on the corporate rule of depreciation that you set for yourself. But as far as the government is concerned, we allow you to claim everything. However, your profit does not allow you to claim everything. So now you have unutilized capital capital allowances carried forward. So this is also going to be subjected to deferred tax rules. So such capital allowance, give you some deferred tax assets, that you are going to be claiming, going forward. Another one is unrealized exchange loss. Unrealized exchange loss is allowable for accounting purposes, but it's not allowable for tax purposes. It's going to be disallowed until realized. So it's only the realized exchange loss in any accounting year that you can claim as far as tax is concerned. So that's definitely going to lead to, timing differences as well. Now, unutilized tax allowance. If you have a tax allowance that has not been utilized and you are allowed to carry it forward, again, that also leads to timing difference. Let me give you an example of a very huge unutilized tax allowance. In the PIA, there is something we call the, CPR, that's the cost price ratio, in which the government said, okay, those of you, in the E&P industry under the PIA, we are going to allow 65% of your revenue as the maximum cost you can claim, with the exception of about 4 items, payment to the host community, NDDC, and others. So we remove 4 expenses, but all the other ones that you have, we are going to allow you only 65% of your revenue as your cost. Now, 35% is going to be carried forward. So the government, and that includes both OPEX and CAPEX. So that's where unutilized tax allowance, comes in. Government has granted you, it's a cost that is allowable under the law, but you are not able to claim it because you don't have sufficient profit, to claim it. Another one is a revaluation deficit, on investment diminution in value. This is based on revaluation. Yes, accounting-wise, revaluation losses and all those things are liable because they are not subjected to the tax rules. Impairment of assets will be allowable as far as accounting is concerned, but not as far as tax is concerned. You need to prove before you can impair an asset under the tax rules. Sometimes I want to, when I remember some demands that the tax authorities do ask about some assets, they are very funny. It's like almost asking for the death certificate of the owner of the business for you to know, that a certain asset is, is impaired, or something like that. Then unrealized exchange gain is another one. We talk about unrealized exchange loss. It's the same thing. Unrealized exchange gain is also not going to be taxed until it is realized. Because, for instance, now somebody is having 1,000 US dollars in each financial statement in 2022. And as at that time, let's say the exchange rate was just like 700 Naira or thereabouts. Now, the rate is now about 1,300 Naira. Or let's use government rate, it's okay, it's around 1,000 Naira. So you have about 300 Naira exchange gain in your financial statement, but the cash is still there. The cash is in the bank, in your USD domiciliary account. You've not exchanged it. But when the auditors come, or even on your own, you have to do revaluation of those, the foreign currencies you have in your account, USD, GBP, Euro. So you try to do all those exchange differences. You look at your balances in December 2022, what are the figures, exchange rate? Now, even if it is only just 1,000 USD you have there, that 1,000 USD, you put it in your financial statement as a, equivalent of, let's say, 700 Naira. But now it's now 1,000 Naira as far as government rate is concerned. So you have gain of about 300 Naira without doing anything. So, but that 1,000 Naira is still in your bank. So that's going to give you an unrealized exchange gain. It is unrealized in the sense that you have not exchanged it. Ask your bankers to convert it from your USD to your Naira. So it becomes realized when you convert it, into Naira. Then it becomes realized. So it is at that time that exchange gain is going to be taxable. So if you do that in this year, 2024, so in 2023, it's going to be unrealized exchange gain. But in January 2024, assuming you now need Naira, so you then convert that to 1,000 Naira now at the rate of the same 1,000 Naira. And if you invariably convert it at a rate of 1,300 Naira, so you have 600 Naira exchange gain, realized exchange gain. And that's why in some, you have a very huge realized exchange gain nowadays, when it escalated up. So all these things are things that, we need to take note of. Now, the last slide on this issue of what leads to deferred tax, quite a number of them, is a general provision for bad, and doubtful debts. This will also lead to anything you see here, mainly significantly provisions. These provisions are not allowable as far as the tax rule is concerned, but they are allowable as far as accounting rules are concerned, unless they are specific specific expenses, that are liable, just like specific, bad debt provision. And when you call something specific bad debt provision, we should know the difference between it and general provision, because this causes a lot of argument between the taxpayers and the tax consultants, the two of them on one side, and then the tax authority, on the other side. And the question is, even some of them, go as far as, going to TAT or goes to court. I know recently we just, we got a case, NPF versus the Federal Inland Revenue Service in respect of a provision for bad debts. NPF Microfinance Bank is the Nigerian Police Force Microfinance, bank to support the police in terms of microfinance. Yeah, they do give some other individuals who are not police, but we had this issue where the NPF is saying that, look, these provisions we've made, they are bad debts, but the authority said, no, they are not bad debts, they're just mere provision and we are going to disallow it. And they came out with, hundreds of millions of tax payable. And they said, where do we find this money? So came to us, we have to file at the TAT after a lot of negotiation with the authorities, and said, no, we are not able to agree with you. And those are the cases where I was saying they were asking for the death certificate of the person. We said, look, some of these people, they have died. These are policemen. Some of them have died, you know, and so they have to, you have to allow it as even as bad debt now, not specific bad debt. And he said, no, okay, go and bring the death certificate. He said, okay, fine. They find some death certificates and not all the death certificate they can find, and there are other efforts to recover the debt. So the key thing here is that when it is specific and it is actual, and there are documentary evidence, the tax authorities will allow. But when it is a general provision for bad debts, they will not allow it. They will not. And so they will be right if it is a general provision. There is no debate about that. And both parties need to agree. But where there is disagreement is in recharacterization of those, you know, of those, whether it's provision or it's not a provision on the borderline. Of course, the authority will take a hard line and they ask you to prove, you know, because you who assert, you know, must prove, but not necessarily, not at all time. Anyway, but that's another subject of discussion. So provision for stock obsolescences, it is also provision. You just look at it, what we have here, we are providing for it. But where those stocks are actually bad and you have certificates, I don't know who need to satisfy that, maybe NAFDAC and all those kind of things, but I know that of the engineering stock, you need any current, you know, certified people to do that. And I think the authorities are going to accept that. Retirement benefit provision, I've talked about that, which is gratuity. You are making provision this year. It's not going to be allowed, but when you pay, then it's going to be allowed. We have a situation here where, I mean, these are where questions might be coming from our members as to people who are still in employment, but they are collecting their gratuity that is going to be paid to them. Is it taxable or is it not taxable? These are debatable, you know, issues. Those who are in employment, for instance, some of the people, they will say they are under redundancy, and then you are paying them gratuity annually. Let me give an example. We have a couple of clients where, yes, they will say the company is not able to, you know, operate effectively. So we are putting everybody in redundancy. And so your gratuity in the next 5 years is going to be like 5 million naira. So we will be paying you 1 million naira annually so that we can manage our cash flow and all those kind of things. So now that gratuity of 1 million that is paid to that person, don't forget that the person is still in employment. Although they've had an arrangement that your employment is terminated, you are under contract, you are only renewing it. You can see where complicated rules comes in and where, you know, you keep on going to the FRS, you know, every day and go to argue. Yeah, the argument is going to be even also with the auditors, because, I mean, the auditors, is it provision you are doing or is it actual, you know, retirement benefit you are granting? So auditors are going to assert their foot and say, look, sorry, this is an employee cost. You have to pay ITF on it. You have to pay, you know, PAYE on it. You have to pay this. Don't forget that gratuity itself is exempted if it is paid to people who are outside the employment. You know, but when you are saying, okay, the person is still in employment and you are paying gratuity, you know, that is definitely going to lead to disagreement with the tax authorities. But again, it's neither here nor there. If there is room to discuss further on issues like that, then that will be fine. I think I have just a few minutes to run. Loss on disposal of an asset will also lead to differences. Profit on disposal as well. You know, loss and profit on disposal of assets. You know, they are not going to have effects on computation of your capital gains tax. Your capital gains tax is going to deal with just only 4 items. Now, you take your sales proceed, you look at what is the acquisition cost of that asset, look at the enhancement cost of that asset, look at the disposal costs, the legal fee, the accountancy fee, and all those kind of fee expenses you incurred on those assets. or litigation costs or any sort to recover that asset for the purposes of sales. These are in the CGT Act. All these expenses are going to be allowable, you know, for the determination of the capital gains upon which you apply your 10%. However, if there is a loss as far as accounting is concerned, that's going to be charged to the financial statement, but that is not going to be allowed for tax purposes. So whatever it is, you may end up paying CGT on an asset for which you still have, you know, you still have loss on from accounting perspective, yet you are paying CGT, and that's where we need to look at it very well. Finally, on this slide is a revaluation surplus on a fixed asset. It's not allowable for CIT purposes. You know, all revaluation surplus are going to be disallowed as far as tax is concerned. The same thing, if you have a revaluation surplus in terms of profit, and you put it in your P&L account, and you say your profit is as high as this, of course, the taxman is going to ignore it because it doesn't really have a real value which they can substantiate. So all those provisions are definitely not going to be allowed. Now, let me quickly rush over some of these examples. Now, we discussed about the tax base of PPE. So a machine costs 250 million, for example. For tax purposes, capital allowances of 130 million has already been granted, you know, in the current and prior periods, and the remaining cost, which is when you remove 130 from 250, you get 120 million. So the remaining cost will be deductible in future, either as an annual allowances or through a balancing allowance on disposal. What is the tax base of the machine? I have explained tax base before as something which is equivalent to the assets or the figures in the balance sheet. The tax base will be something that you can treat in future for tax purposes, and probably you will find that on your tax computation. If it will not come to your tax computation, it will not form your tax base. Now, the tax base of this machine, we'll just give the solution here, you know, for the purposes of this exercise as 120. And how does that, you know, what does that mean? Because when you have a machine that costs 250 million, you've claimed capital allowances of 130 million initial capital, put everything together, remove it, you have 120 million. So in future, your capital allowance claim is going to be based on that 120 million. If it is not going to be claimable in future, there is going to be nil, but this is going to be claimable. So let's move to the next example. So example 2, interest receivable has a carrying amount of 25 million. Interest receivable, not that you have received it. So you need to look at it very well. So where is it going to be on your tax calculation? It's not going to be there. Yes, the company knows we are going to receive interest, you know, of 25 million. But Mr. Taxman will just be looking at you. We are with you. The moment you receive the 25 million, we tax you. So basically, it's not going to be in your tax computation. And so the tax base for that is going to be nil. Let's move to the third example. Dividend receivable, you know, from a subsidiary, you know, having a carrying amount of 100 million. As you know, that dividend is a bottom line, you know, and it's not taxable. So if they ask what is the tax base of the dividend, you know, receivable, which is 100 million, we need to asterisk to say that under this analysis, there is no taxable temporary difference. It's not, you know, dividend is something you receive after tax. So the rate applicable to it is going to be nil. So let's look at another example where you have current liabilities, you know, include provision, which are carrying amount of, say, 500 million. Provision, you know, 500 million. Related expense will be deducted for tax purposes in future on a cash basis. So where you have that, you know, of course, you're not going to have it on your tax base, on your tax computation stated anywhere there. So the tax base of that is going to be nil as well. You know, all these things I would have loved us to interact and say, okay, what's your own answer here? What's your own answer here? What is the basis for it? But we don't have that luxury of time. So we've put all these things on the slide so that you can, at your leisure time, you can look at it. If you have any question, we can talk more about it. Example 5 out of 7, current liability include interest revenue received in advance, you know, with a carrying amount of 400 million. For instance, if you receive 500 million now, you charge 100 million to your revenue, that 400 million is not going to be stated in your tax computation. And that's why we said the tax base for that going forward is going to be nil. It's against, you know, the capital allowances where you claim and you stated it on your tax computation as carry forward. That is the difference between the two. This one is hanging somewhere there, you know. But as I said, there are a whole lot of debates on it, because those who are working for the government might have a different view, just like my very good friend that dragged us to Senate and said, you are not remitting the tax on these amounts. We are not supposed to remit it because matching period, that's not the period for us to do that. So another example where you have current liabilities include accrued fines and penalties with a carrying amount of 700 million. We need to know that fines and penalties are not deductible for tax purposes. And that definitely is going to lead to a permanent difference. So from the analysis, there is no deferred tax liability on that. And finally, I have an example here, you know, of an asset purchased for 1,000 naira. It's just going to be for our templates. And you can see, I've given this example quite a numerous times during this discussion, of which an asset was purchased for 1,000 naira. Year 1, you see the depreciation line, you know, on top there, based on accounting value of 20%. So you have 800 carry forward in year 1, 600 year 2, 400 year 3, and 200 year 4. If you look at the tax written down value on how to determine your deferred tax, in the first year, because the, sorry, let me go back because I think I moved too fast there. You can see here that the company claims tax depreciation of 25% per year on a reducing balance, you know, basis. The applicable rate of corporate tax, you know, is 30%, whereas the depreciation is 20%. It says it's on a straight line of 5 years. 5 years depreciation is actually 20%. So if you remove 20%, which is 200 from 1,000, you get 800. Remove another 200, you get 600, and so on until you get 200 in year 4. However, the tax written, the tax depreciation, which is capital allowance, is 25%. So 25% of 1,000 will give you 250. You remove that, you get 750. Next one, you get 500, you get 250. So you can see on the 4th occasion, you have 250. Then you still have the 5th year there where you have 200. So in computing your deferred tax in year 1, when your depreciation or the carrying cost of the asset as per the financial statement is 800, your tax written down value is 750. So it is only on 750 you can claim capital allowance. So the difference between the two is 50. 30% of 50 is going to give you 15. So that 15 is your deferred tax that you need to provide for. If your tax payable for that year is 10, this could be in million, it could be in thousands. So if you have 10 million payable tax, and then you have deferred tax of 15 million, so you add the two together, the provision in your account is going to be 25 million. And this is where we had issue with my very good brother at the Senate to say that this 15 million is also payable to the government. And we said, no, this is deferred tax, which is carried forward for, you know, regularizing, you know, your account. So, I mean, you can use any figure to explain this, but that's the way that works. So finally, we have the general rules. Generally, you should provide for deferred tax if the accounting treatment, of an item differs from its temporary treatment. The differences, will result in a higher or lower amount of income tax payable in the future. Otherwise, no deferred tax is required. The general rule is, however, subject to initial recognition exception, to be considered, later. So deferred tax recognition is based on IAS 12 in terms of how you must provide for deferred tax. And it states an enterprise should account for the tax consequences of transaction and other events in the same way that it accounts for the transaction and other events in the financial statement. Thus, for transaction and other events recognized in income statement, any related tax effects are also recognized in the income statement. For transactions and other events recognized directly in equity, any related tax effects are also recognized directly, in equity. IAS 12 revised, requires that deferred tax asset be recognized when it is probable that a taxable profit will be available against which the deferred tax asset can be utilized. Let me explain this a little bit. Sometimes you have some withholding tax credit claimable, a huge amount. You may not be able to go to FRS to claim refund. So do you make provision for it or you don't make provision for it? If the company is making loss, and it's likely going to even wind down without necessarily being able to claim this deferred tax, how will you make provision for deferred tax assets? It's not going to be claimable. So that's the point we are trying to, make here. Strategic consideration, which is the final slides here, assessment of future tax rates and tax law changes. Now, this is where I said we can benefit from deferred tax if we manage it very well. For instance, under the PIA, the government has already told us that those under the petroleum profit tax are going to be, converting to the hydrocarbon tax and the company's income tax. Now, the rate of PPT is 85% for those who are there. Then, if you are converting, let's say marginal field, you are converting and then you'll be paying hydrocarbon tax of 30%, and then your company's income tax of 10%. So the two is, let's say, 60%. 85% moving down to 60%. So what do you need to arrange that is going to lead to a deferred tax advantage for yourself? And that's the point, so that you can push as much profit taxable to the 60%. And that's what this is looking at when you have, a lower rate for future. So what do you push forward under the deferred tax, so that you make whatever claim you need to make now and pay a reduced rate under this and push more income to where your reduced rate is going to be lower. But that is as much practicable as possible. Under transfer pricing as well, because you have different rates in different jurisdictions, that gives you also an advantage. The relationship with tax incentive and tax credit, you have pioneer period, those who are in manufacturing and all those kind of industries, you have those pioneer period. Your asset is going to be deemed, the cost of your asset is going to be deemed to be on the first year post-pioneer. So you need to look at the cost you charge during the pioneer period, and you also need to look at your deferred tax assets, what you are going to be claiming, after the pioneer period. I just give that as an example. So strategic business planning is very important so that there will be future inflow, of economic activities. And then finally, top-notch cash flow management and planning is very important, based on what we have discussed. On all these scenarios, you look at it very well and see how you position your clients, very well to be able to make maximum advantage of that and recognition. So if you are able to make recognition, if you are able to make recommendation to your companies, of course, they are going to be very happy with that, and your KPI is going to go up. And of course, there is going to be financial reward in it for you. So is the financial reward for those who are in the industry, for those who are also consultants working for establishments. At the end of the day, this is where your organization can benefit from it. So I thank you all for listening, and look forward to more interaction. Once again, I thank the chairman of Mpaan, as well as the committee, and our able chairman of this session, my very big brother, Oladele Oladipo FCA council member, for the opportunity given me to do this presentation. Thank you all.
All right, thank you, my brother Alhaji Azeez Alatu Jazakallah Khairan. I really want to thank you for keeping discipline with time. You were timing yourself, so there was no need for me to come in and begin to time you again. So I really thank you very much for that. That was a very, very richly put together paper, and I'm also very grateful that you were even able to share examples with us. You know, you gave us a very good theoretical background and sharing with us some of the key terminologies in deferred tax accounting, and you also summarized some key points for us before even going into further illustrative. So we really thank you for that. There'll be time for question and answer shortly, but one of the other things, one of the takeaways that I like from the presentation that our brother has made is that for our members, we need to be committed to self-development. If you don't remember what deferred tax accounting is, as you have said, please go back to your IAS 12 and also go back to your Companies Income Tax Act. So we can also begin to develop ourselves further. While the paper presenter was making his presentation, we had a number of members join us. One of those that joined us, and I'd like to crave the indulgence of the organizers to recognize, is our revert past president, in the person of Alhaji Razak Jayola. You are welcome to the program, sir. I don't know if you want to unmute yourself and just greet our members. Our revert past president, sir.
Thank you very much, my distinguished counselor. I want to appreciate the organizers of this program. I came across the flyer during the week until last night before I really made up my mind. Unfortunately, I didn't arrange to join quickly. So the program has started before I contacted one of my daughters, Wasilat, for assist, and she was able to assist with the company of Sanusi. I'm very happy to attend. What actually drove me is issue of transfer pricing, on which I'm trying to do something now, and issue of deferred tax. I'm not a tax person, but I found the presentation extremely very, very useful for purposes of refreshing my memory and all that. And I like the details that my dear brother Aziz has gone on this. So please keep it up. God will bless each and every one of us. Thank you.
Thank you, sir. It's nice hearing from you. Thanks. Yeah.
Yes, thank you, sir. Incidentally, I was in a meeting with Alhaji Jayola last night. Little did I know that we are going to meet here again this morning. Yes, sir. I see a couple of hands up. I take it that you want to ask questions. Can I just crave indulgence? Let's suspend those questions for now, so that we can take some contributions from one of our sisters, Mrs. Olubusayo Amol. We are going to give her about 10 or maximum 15 minutes to make our own contributions. And after that, we'll all come back and spend some more time with the paper presenter, where then he will take all the questions that we have. One of the things that have been posted on the chat group is whether you have access to the slides. I want to believe that the organizers will make the slides available to all participants.
Yes.
Right. So,
Yes, sir.
okay, good. MC, do you want to introduce the contributor,
Okay, yeah.
Mrs. Olubusayo Amo, and she will have 10 minutes to make her own contributions. Thank you.
Okay, thank you very much, sir, Chairman. Yes, since Olubusayo Amo is a senior manager with over 11 years experience in tax, regulatory, and people services. She's currently a senior manager with KPMG. She has a BSc Economics from Redeemers University. And of course, she's a chartered accountant, member of ICANN. She's experienced in consumer and industrial markets, agriculture, shipping, energy, and natural resources. Lubusayo is married to a beautiful baby girl. So I'll hand over back to the chairman and then to Lubusayo to take the contribution for the next 10 to 15 minutes.
Okay, all right, thank you. Sister Bismillah, please go ahead.
Bismillahirrahmanirrahim. Assalamu alaikum wa rahmatullahi wa barakatuh. Please confirm that you can hear me.
Yes, we can.
Yes, loud and clear.
All right, thank you very much. So I stand on existing protocols. Good morning, everyone, and thank you for joining this session. I hope that you will be able to make the most of it in terms of all the relevant contributions that the presenters will be making. And I'd like to say well done to Alaji Alatoye on the presentation, because deferred tax is an area that sometimes proves tough for accounting professionals, especially in practice where different issues can be thrown up and you're trying to jive your computations and so on. Also, sometimes it can actually be quite a technical and naughty area, but I think he has provided good insight and context with respect to the subjects. So well done, sir. And I particularly like the strategic aspects that he covered in his presentation, because a lot of times people are usually just focused on the computations, but it's important to also pay attention to the strategic aspect, because that's like the end game. So when you finish your deferred tax computations and so on, what does it mean for the company? What can the company do to maximize whatever assets it has? Are there chances that the company will be able to offset those assets in the future? And how can they plan to make that happen? So thank you very much and well done, sir.
Thank you.
So I will just provide a summary of what deferred tax is. And basically, deferred tax is just what you find in your financial statements. And so what you find in your financial statements is actually a tax expense based on the International Financial Reporting Standard. And this does not necessarily form the amount that companies have to pay. To be honest, I actually found the experience that Alaji Alatoye shared in terms of someone saying, oh, go and pay your deferred tax provision into the FIRS. I think that was so hilarious, because really that just shows that there's some knowledge gap in this area and we really have to pay attention to it. So what you find in your financial statements is tax expense, and it's actually based on IFRS, but we know that tax payments are based on your tax laws. So what you find in the FS is not necessarily the amount that companies will have to pay. What companies have to pay, that's the actual cash outflow, is shown in the notes to the financial statements as the current tax expense. So but IFRS requires that financial statements include the deferred tax expense, which are taxes applicable for the current year based on accounting profits. So fine, you have your tax laws and all that, but IFRS requires you to still show what should be applicable based on accounting principles. So DT is an accrual. So deferred tax, so it's popularly referred to as DT, is an accrual for taxes that are applicable in the current year based on the accounting profits. So while you only pay the current tax expense, IFRS requires you to accrue for the other taxes applicable in that year, even if you are setting it, or even if you are settling it or offsetting it in the future. So that's basically what the deferred tax is about. And it only arises based on temporary differences. So if there's anything that is a permanent difference, such as fines and penalties, facilitation expenses or bribe and so on, which are clearly not allowable for tax purposes and which you cannot offset or which you cannot get a benefit for in the future, those will not give rise to deferred tax to any, it shouldn't feature in your deferred tax computation at all. And IFRS will require you to show such permanent differences in your effective tax reconciliation. So I won't want to delve too much into the technicalities because definitely Mr. Alatoye has already done that. But I think it's also important to pay attention to the strategic planning opportunities, because when you have deferred tax assets, you have to think about, okay, so for example, if a company has incurring losses, you have to think about what that means for the business, the strategies you need to employ for the business in the future to ensure that you're able to make use of the assets that those losses will give rise to. If you've had tax incentives in the past as well, whatever assets you create, you need to think of ways to maximize those assets. If you have huge capital allowances that you haven't been able to use to offset in terms of your taxes, you also, those things are things that give rise to deferred tax assets. So you need to think of, okay, what do you need to do to your machinery, to your equipment, and so on. So these are areas that people actually need to really pay attention to and read extensively on. So I'd like to stop at this point, and thank you very much for the background provided by Alhaji Alatoye, and we welcome questions and comments now.
All right, thank you, Assistant Jazakumullah Khairan. Thank you for that, and also for particularly emphasizing the strategic considerations in the tax planning. So thanks for that. Again, we also thank Alhaji Alatoye for the erudite presentation he has made. Now we quickly go into the question and answer session. You will notice, members, you will notice that I've already thanked the paper presenter and the contributors, so you don't need to thank them again. Just go straight ahead to your questions and comments. Raise your hand if you want to ask questions. We'll take them in batches of 3 so that the paper presenter and contributor can consolidate and answer them. But please, if somebody has asked a question you have in mind, you do not need to repeat that question. All right, so the first hand I see here is Afiz Yusuf. Please go ahead, sir.
Good morning, everyone. So my first question is, there are situations where we have deferred tax assets and deferred tax liability, like the first year deferred tax liability and the next year deferred tax asset. So my question is, does the law allow it to be netted off against each other in the financial statement? That's one. My other question is there any circumstance that warrants leaving the deferred tax liability or deferred tax asset the same over the years? Because I've seen some financial statements whereby we have the same figure for deferred tax liability in the same year. So I wonder that, why is this so? So is there a law that allows that to be done? That's all I have.
Sorry, can you clarify that second question? I don't know if our paper presenter got it.
No, I don't actually. I wanted to ask him to clarify. Yes, thanks.
Yes, please clarify.
Okay. The second question I was asking if the law allows deferred tax asset or deferred tax liability to be the same in both years. You know, in the financial statement, you have the current year and the previous year. So I've seen financial statements where we have the same deferred tax, the same figure for deferred tax asset or deferred tax liability. I don't know if you guess that. So I'm asking if the law allows that, because it's supposed to be calculated every year.
Okay, all right. I think we've got that now. Okay, thank you, Hafiz. I think we've got that now. Zina Seriki, please go ahead, Bismillah.
Assalamu alaikum warahmatullah. So my question is on, I have two questions, please. One is on deferred tax assets. So for a company that have deferred tax assets and then eventually becomes profitable, so what happens? How will the company utilize the deferred tax assets? So let's assume when the company become profitable, the current tax is like say 10 million. The current income tax payable is like 10 million. And then the company already have deferred tax assets of 113 million in its balance sheet. So how does the company begin to utilize its deferred tax assets? That's one. Then my second question is on unrealized exchange gain. So for a company that have unrealized exchange gain, you know, the gain becomes realized when the company probably converts its USD into, let's say, Naira, exchange it into Naira, and then it realized the gain. But for a company that did not eventually convert it to Naira and just spends the dollar as it is without converting it, so it means it did not actually realize that gain. So what happens for tax purpose? What happens to the unrealized gain that has been recorded before and did not eventually become realized?
Okay, all right. Alhaji Alatu, I don't know if you want to take those two sets of questions or add one more.
Okay, I think we can add the Otumba, just to make it I think we have a rule of 3, right?
Yes, 3. Yes. I mean, I thought they were going to be asking one question each, but they're not asking 2 questions. Let's take those 2 for now.
No, you are right.
Take those 2.
So we can take this and then take the other 2, make it 2. Yes. Thanks very much. Mr. Hafiz Yusuf talk about deferred tax assets and deferred tax liability in the same financial statement, and ask whether the law, allows that. I think one of the things we need to first get clear is that deferred tax is not an issue of law. Rather, it's more of an issue of IFRS, the accounting rules and accounting principles, which is based on IAS 12, as I have stated. And when you have deferred tax assets on any asset or on computation, basically you have a section on the tax provision, and you have a whole lot of details there in terms of the notes that you have to the accounts. And you also have details in terms of the computation in your deferred tax session, both by the company as well as the auditors, which forms the basis of you arriving at whether you are having a deferred tax asset or whether you are having a deferred tax liability in respect of an asset. So you may be having deferred tax asset on an item, on another item in the same financial you have a deferred tax liability. But in your tax provision section, what you are going to have, is what you have there in terms of the note and the details that's going to indicate what your deferred tax asset is and your deferred tax liability for each of those assets. And you keep on treating them, for the future reversal of those assets. Then the second one is, you said, if law allows deferred tax asset and deferred tax liability provision to be the same in maybe year in, year out. I think what you are saying is where there is no movement, in the deferred tax provision. That's what you are saying. If those deferred tax bases, are basically the same. For instance, you have a capex, you have like 1 or 2 years where you make some profit and you make some claims, and then subsequently you are not adding to the asset as well as you are not making profit. So probably your deferred tax provision is going to remain constant for maybe 1 or 2 years until you have a different tax base in subsequent years. Maybe you add addition to the fixed asset, or you have a disposal of those fixed assets which goes through the capital gains, and then you have a difference, you know, in your figure. So that's the way I understand it, but I think Dele might understand that question more, but that's the way I pick that second question. Then Madam Sinat did ask that if the deferred tax, you have a deferred tax now, and then the company is profitable in future. I remember very recently there is one of our clients that applied, you know, for pioneer status. And so while in the process of reviewing their accounting details, I discovered that they have assets that worth, you know, close to 3 billion, you know, naira. And I look at their annual profit, probably is around 300 million or thereabout. So I projected this 300 million, assuming the company is making the same profit for over, let's say 3 years in the first instance, and then 2 years in subsequent year, because they are in manufacturing. So they are, you know, eminently qualified, you know, for that, and they're just starting their business. But if you are making a profit in the next 5 years, it's going to be about 1.5, you know, billion that you could claim in capital assets. Meanwhile, I have noticed that the investment they already did is about 2.6 billion there. So basically, they can claim those capital allowances. They are having that deferred tax asset there. They can claim, you know, the whole 1.5 billion over the period of year with the capital allowances that they have, because there is no restriction on manufacturing assets. And so the idea is that, yes, you are making profit, but yet you have CapEx that is more than that. So the question is, should you go ahead and still claim the pioneer, you know, salary for what? And so the conclusion that could be reached then was that, no, I have to, you know, we have to advise them that, no, that's not a good option to go, because even if you compute your 300 million for 3 years, you get about 900 million, and you are going to pay 2% levy, you know, to NIPC on that, you know, on that amount in the first instance before you are able to get that certificate. And at the end of the day, you're not going to have any benefit. So it's not everybody that you rush and say, you know, this. So at the end, they have to appreciate that. So I think that is one of the things that Sister Zinat is looking at, where you have deferred tax asset and you are having, you know, profit as well. It depends on the level of the profit. Where the CA or the capital allowance is far higher than the profit you are making, then of course, it's going to be over a period of time that you will be able to set off those profits against the capital allowances. And where the deferred tax asset is smaller, for instance, if the capex they are carrying forward is just something like 500 and in the first year they will set it off against their profit, then you can consider it that don't claim this exemption from this year. And that is where the strategic planning comes in. We need to sit down and look at it very well. That look, in year one, you already have capex that is going to wipe off your profit. So if you are going to start, you know, an exemption, it's better you start in year two, you know, and all those things. So that question is a very good question that needs to be looked at in much details for strategic planning, you know, there. Now, the second one is unrealized exchange gain in USD, in which the USD is spent rather than converting it into Naira. You know, I believe you will still have to convert it into Naira in one way or the other by recognizing it in your Naira financial statement at certain rates. You know, if the rate at which you are recognizing it at the end of the year is higher, and of course you are going to book some income, you know, into your plus there. So if you book it, and these are the gray areas that I said the tax authorities are going to have a different view, even if you have a different view that, look, I didn't convert this USD into Naira. All I just did was I spent it like that. Now, but the rate at which you post it in your financial statement, if at the beginning of the year it was 700 and at the end of the year it was now 830 or thereabout, let's say 1,000. So that 300 Naira, if you charge it as, can you say it's unrealized? If you say it's unrealized, the taxman is not going to allow, it's not going to agree, because the value at which you pay the 1,000 Naira now carries more 300 Naira equivalent. You know, so the question you've raised is a very technical question, also controversial, because the company's position will be that, no, sorry, it's unrealized because I never converted it into Naira. But the tax authority's position is going to be it's realized, to the extent that it's no longer in your balance sheet. You've already spent it. And in your spending, you spend 300 Naira more than what is in your balance sheet before. And so therefore that 300 Naira is realized. And so those are the kind of things that go to TAT. Everybody start arguing, you know, whether it is realized or it's not realized. But to be very honest, I think that would be a realized exchange difference as far as your books is concerned, because it's not going to be in your books again. It's gone forever. And then you've actually gained a 300 Naira in terms of your spending. You know, but again, we can look at it in much more detail. So I think those are the two questions. If there are contributions there, that would be very fine. But before we go to the next batch of the question, let me also join the chairman of the session, council member, to welcome our past president, Alhaji Jayola Razak. I know I am owing him something, so I definitely will come back to him on that thing, and I have to sincerely apologize, sir, that I am honestly with you, and I will come back to you, inshallah, Aziz. You are most welcome, sir. So thanks very much, Billy.
Thank you so much.
Yes, sir.
Okay, all right. Thank you, Alhaji Zalati, for those answers. I think in particular, the experience you shared or the illustration you made around, tax holiday, where companies in pioneer status, how can they utilize the deferred taxes they have and when they come out of profit? I think that just speaks to the fact that as accountants, whether you're working in accounting or tax practice, or whether you're working in the corporate environment, it's important that we are able to, be anticipatory as part of your business decision making. You need to plan and you need to examine all the variables that will take place in making a business venture and investment a profitable one. Let's not wait until we get to that situation and we then start asking ourselves, oh, can we take advantage of the tax laws and accounting provisions in this instance? The value that we can bring to the business is to enable them plan ahead and consider all variables. Alhaji Aziz, before we go to those hands that are raised, there's a quick question in the chat room. Somebody is asking that can we say that tax base is the same as tax written down value? And then
yes.
Another person, okay.
Yes, I think that is straightforward answer. I think I did mention that okay. Tax base is the tax written down value that can be carried forward on the basis of your tax computation. Yeah.
Okay. And then another one, what is the implication of recognizing impairment in deferred tax computation while the movement in the year for credit loss is not disallowable in the income tax computation? That's from Dauda Yakubu.
Yeah, I think he needs to explain that a little bit more, because impairment, as you know, is not allowable for tax purposes. So if you reduce the value of your asset as far as tax computation is concerned, that's not going to be allowed. And probably lead to, it's not going to lead to, let's say, like a timing difference, because at no time is it going to be allowed for tax purposes. It's just going to be for accounting provisions. And that, I think we need to note. Yeah.
Okay. Okay, all right, thank you. So we have just 5 minutes more for Q&A. I saw one hand up before, but it has gone down now, Tomori. In any case, Abdulrahman Afolabi, please go ahead with your question. Can you make it one question, please, so that others will have opportunity to ask?
All right.
Well, thank you very much, Mr. Moderator. Alhaji, salam alaikum.
Wa alaikum salam wa rahmatullahi wa barakatuh, Otumba. How are you today?
Thank you very much, sir. I just want you to share your experience so that people can also benefit. You know, in our previous words, there's always this pushback from our assurance colleagues who should take responsibility for the preparation of deferred tax. Most especially in practice where you have the tax unit support the assurance colleagues. Did you get my question?
Oh, yes, I pick your question as to whether it's supposed to be tax unit or the audit unit that should take responsibility.
Exactly. Yes.
That's very interesting, because tax law is with the tax unit and the IFRS is with the audit unit, and but
Absolutely.
under the concept of one firm approach, you need to look at the partner, if the partner is in charge, and say, you go and do this and do this. But that's on a lighter mode. Generally, I think the tax unit need to advise the audit units about your tax section, generally. Now, they have to explain, even not only the deferred tax, they have to also explain to the auditors the basis of their tax calculations. And so the auditor will have to review it in details and make sure that they are in agreement, because auditors are chartered accountants who also have responsibility for whatever they are signing to be true and fair. So you cannot just, give that. In terms of review, I will give the responsibility to the to the audit unit. But in terms of the computation, I will give that responsibility to the tax unit. They need to do that tax computation correctly, because they have the tax written down value of various ones, the tax written down value from the CIT, and then the CGT computation as may be applicable, as we mentioned, on those that can give a tax effect. So pull the two together and then advise the audit unit, and also give copies of those computations to them so that they can audit it and confirm whether it is right or wrong before, they put the figure in the financial statement, or they certify it to be true and fair. So, but what I have said is in respect of MNEs, bigger companies, bigger corporations. We have small companies where the auditor is also the tax consultant. So who is giving figure to who? He will be the one to do the audit. Of course, we also have a scenario where the company is able to prepare the financial statements and then give it to the auditors to audit. The company also have probably internal tax departments. They will have done both, and then they will give it to the auditors to review. So the auditors, are going to give the tax, depending on the size of the firm, to review the tax, and then they take it on, and then they sign off. So there is really no one answer fit all, to this question. Where the company is a very small one and they still like a medium company, and they still need to do all these things, and their auditors are the one that do the tax computation and then do the filing, and he is a member of OFICAN and CITN, and he goes ahead to do everything. He's going to be only one person that will do the tax computation, do the audit, and do everything, although that's not encouraged, because he's supposed to have a tax unit also under his audit to review both the CIT as well as the deferred tax, as an, a more specialized environment. Not that he is not qualified, but you have some people who concentrate on some aspect of that so that they can give you correct advice. So in big entities, I think all those things have to be done by the tax people and then given to the auditors as a reviewer. That's my view. I know Dele will handle more of that on a practical basis. Yeah, as far as we are concerned, we only do tax in Ascension. But I know, the firm does both for audit and tax, and we can leverage more on his experience. Thanks.
Okay, all right, thank you. Thank you, Alhaji Latwi. I mean, what I'd just like to add to that question is that ultimately the auditor takes responsibility for his opinion on the financial statement, right? So even if the tax computations are done by a tax specialist, the auditor still has a responsibility to review those taxes, and it is only when he's satisfied that he can then allow for them to be incorporated into the financial statements. And remember that the auditor, even by his own training, is supposed to have a good knowledge of tax himself anyway. So irrespective of who prepares it, the auditor is ultimately responsible for that number in financial statements. In the interest of time, we'll only take 2 more questions from Temitope Kushimo and Kazim Tomori. All other questions that are on the chat group, can I please ask the organizers to collate them, share them with our paper presenter? I'm sure you can provide some straight to the point written responses, which can then be circulated to the membership of Mpaan. So please go straight to your question, Temitope Kushimo, and then our paper presenter will answer it very briefly. So we take the 2 questions, one from Temitope and the other from Kazim. Thank you.
Okay. Good morning, everyone. Mine is more of a request and observation. So let me just take it from the request. So I want to know the difference between.
Can you please speak up? Can you please speak up?
Okay. Is it better?
Yes.
Yes.
Okay. So I was trying to ask the difference between deferred tax assets and liabilities, because I didn't hear. I don't know if I missed it. We are using both in tax line during the presentation. So what's the difference between deferred tax asset and, because it's sometimes very confusing. And also the next request is, since this training is more of an advanced training, so we didn't hear about debit and credit side postings of the transactions, because that's another confusing area as well. Then the last request is for us to not say that we should go and read. I believe this training, the purpose of this training is for us to come and understand. So I don't know why it was said that we should go back to read. Only if that area is not pertaining to deferred tax, that's when we probably can say we should go and read more on that. But if it's pertaining to deferred tax, I'm thinking we should lay it out here so everybody can understand. And that leads me to my observation, which is that since the session is kind of in a rush.
Can you please round up, because we have others that are going to ask questions.
Yes. So this is my last point. So that's my last one. Like, since we are in a rush, I don't know if there's any reason for that.
Okay, I can answer that question for you. We are professionals, right? When you come into a forum, especially an educative one, you really cannot expect to get all the knowledge and understand all scenarios and possible variables within that session of 1 hours or 2 hours. In order to deepen your foundation, and that is very important, in order to deepen your foundation, you need to go back and study yourself. It is that body of knowledge that can then begin to appreciate the various circumstances and scenarios and to build upon that body of knowledge. You need to do that yourself. It's an investment that you need to make in yourself. So just as we've said during the program, and as the paper presenter said, go and read the relevant accounting standard, go and read the relevant tax laws, and those are the things that you then apply going forward. One of the objectives of this session is to be able to, help us know, at least at a very basic level, and that's why the presenter went into the key terms and terminologies. At the very basic level, what are those things that are relevant from a deferred tax accounting and management perspective? It is not the objective of this paper or the presenter that everything under the sun relating to deferred tax you will learn here. So Temitope, you have a responsibility for self-development as well. So the other questions that you asked, I'll leave them for the paper presenter. Let's take the last question from Kazim Tomori.
Yeah. Assalamu
Alaikum salam.
My question is, my question is though that please, is there any authority that can issue a certificate for stock obsolete?
Okay,
is it
we
clear,
hear
sir?
your question, even though it is not directly related to deferred tax, but I'm sure the paper presenter can address your question.
It was mentioned.
Yes.
Alaji Alati, go ahead, sir.
All right. Thanks very much, Mr. Chairman of the session and council members. So on the first question as to differences between deferred tax asset and deferred tax liability. Deferred tax liability, as I have explained, the two are different. What you will be paying tax on in the future is deferred tax liability. Just as the name, suggests, you will be paying tax in future in respect of something you have claimed now. Deferred tax asset is the claim you will be making in future as an asset. For the two, I'll give two different examples. Where you are having the tax allowance, you are claiming more capital allowances on an asset now. You will be having depreciation in future for which you are not going to be having capital allowance. So in that case, you'll be having deferred tax liability for which you need to provide for now. But the other way around, when you are having a tax credit, which is an asset to you, it's like cash, and you don't have any liability for this year. And those are the ones that sometimes people apply for a refund or for future tax claim. So that is going to be a deferred tax asset. So the one that you are having resources to claim against your tax liability in future is deferred tax asset. And they are in the slide. So if you look at it very carefully, you will see those things there. As far as the debit and credit is concerned, I mean, debit one account, credit the other account. It depends. When you have an asset, it's always a debit, you carry that one forward. When you have a liability, it's on a current asset, you have that one carried forward. So we can look at that. Time will not permit us to look at that in much detail, but it follows the same accounting principle. One is an asset, it is under, asset. When it is a liability, is under a liability. Well, all those things are going to be under tax provision, which is generally tax, which you have tax note for in the financial statement. Mr. Chairman has already answered that this session is supposed to, train us 100% on the issue. Just a very little one I want to add to it is that it is my honest belief that the best presentation in this whole world, that is 3 hours, that will go through any topic whatsoever, cannot give audience more than 20% of what they need to know. That's an hypothesis, but I think it has been proven. Even when you are in the class, you learn quite a lot. I think it's just about 20% you need to learn. The rest, 80%, depends on each and every one of us. And I think Chairman had already answered that. As I said, IAS 12 alone is over 40 pages, I think about 42 pages. So, and these slides are very small slides. If you compress all these slides together, I think probably maybe like around 5-6 pages max. So what about all the other knowledge? So, and the time we spend here, we need to be very mindful so that it's not boring to our members, because they need to, you have to be very brief on the topic you have chosen, and then people will go and develop that. And it's not everybody that will be overloaded with knowledge. It depends on what each and every person needs. So thanks very much for that observation. Then the last one, by Kasim Tomari, is whether there is any authority to certify stock obsolete? And the answer there is yes, but it depends on what is being certified. Because FRS will not just allow you saying, this is stock obsolete and we have written it off. If you don't have a certificate, they're not going to accept it. But why I said it depends on the different authorities is that if it is pharmaceutical, for example, drugs, you need NAFDAC certificate for that. Otherwise, they're not going to, and you invite them, you also invite the FRS. You declare those things as obsolete or whatever so that they can allow it. I know we have quite a lot of argument and debate on different clients. If it is engineering stock, for example, as I mentioned in the past, there was one we had a specific argument on because one of our clients that is an engineering company in the oil and gas industry, they generated the certificate from their own internal engineering department. And we're having the issue with the FRS. They are current members, but FRS is still saying no. They must use a consultant or external people to do it. And the second thing is that they have to be there, for it to have been allowed. So it depends on the industry that people are. We have experts in each of those products. And it is those experts, the FRS will rely on a third-party certificate. From experience, I think we might have issues if you want to use your own expert in your own organization. So I would recommend you use a third party, get the certificate, even if your internal unit has already done the work. Don't mind to pay the other parties because you may lose 30% or you may go to court and start arguing unnecessarily. And I think that's one of the benefits of this session. So thank you very much, Mr. Chairman.
All right, thank you very much, paper presenter. Like I said, all the other questions in the chat group will be collated, sent to you, and we can then, hopefully the organizers will send the responses to our members. But permit me, Alaji, there is one particular question I need to take out of concern, right? Okay. Out of concern. I don't know what time that member joined us. It's from Adewale Adebola. And the question is, at what point is deferred tax asset deductible from tax liability? Do you need tax authority to approve before deduction? That one you will take. There's a second part to it, which is why I said out of concern. For deferred tax liability, is it an obligation for the company to pay taxes on?
Okay,
I say out of concern because if at this point we are still asking this question, then maybe the message has not sunk in yet. So the first part is, at what point is the deferred tax asset deductible from the tax liability? And do you need an authority to approve that? The second part is, for deferred tax liability, is it an obligation to pay?
Yeah, it seems, I mean, the Jazakallah khairan jaza, Mr. Chairman, for this concern. I mean, it's a concern, and that is why I said we need to pay attention from beginning to the end of the slides. But briefly, when you say at what point is the deferred tax asset, deductible from the tax liability, it's something that crystallizes. It's not like a deductible or not deductible in the particular year. So the right word to use there is crystallizes, over the year. So I will leave that at that. And then you also said that you need a tax authority, to approve before deduction. The answer is no. It's based on the IFRS provision. And it's more of accounting issue, has nothing to do with the tax authorities. So if you make provision for it, it's going to be in line with the IFRS. The only person that can say yes or no is the external auditors. If the external auditors review your calculation and they have a disagreement with the tax base, of course, then they will disagree with you and give their opinion and say, sorry, no, this is incorrect. I've had quite a number of that to the extent you need to give an opinion. So it's the auditor we are talking about here when you talk about IFRS and then the audit. Then the last one is for deferred tax liability. Is it an obligation for the company to pay taxes on it? This was my first point, in this presentation, which took me to the Senate to go and start debating on whether the VAT tax is payable or the VAT tax is not payable, because provision had already been made for it in the account from the company's profit. And then they believe the company is keeping the profit. But the answer is that the VAT tax is not payable at all. And that was the first point I made to all the attendees of this program, you know, that we need to let our members know that, please, the VAT tax is not payable at all. It's not payable to the Federal Inland Revenue Service. It's not payable to any authority, you know, whatsoever. Please, I think we need to hold this and then be able to explain it to anyone at any level when they are having that kind of misconception. So again, I say Jazakallah khairan jaza to Mr. Chairman and then to all the participants. Jazakallah khairan. Assalamu alaikum wa rahmatullahi wa barakatuh.
Wa alaikum salam wa rahmatullahi wa barakatuh. All right, so paper presenter Alhaji Aziz Alato, you've done justice to the topic, and I also like the fact that you are able to share personal experience to demonstrate some of the concepts that members are asking for. So Jazakallah khairan for that. We also wish to thank our sister, Mrs. Olubusayo Amo, for a short but very deep and concise insight into the paper as well. We know that there's no amount of money that we can give you, but we pray that Almighty Allah subhanahu wa ta'ala will reward you abundantly for the support that you have shown Mpaan and for the knowledge that you have come to share with us. So Jazakumullah khairan for that. Thank you very much, Alhaji Aziz. All right, thank you, sir. So, Mr. MC, I think we are doing well for time. I don't know if our second paper presenter is around. What I want us to do to all our participants is to see if we can finish this before Zoom. All right. So, MC, is the second paper presenter available now?
Yes, sir.
Wa alaikum salam wa rahmatullahi wa barakatuh. Let me yield to the MC so that the MC can introduce the next paper presenter and read his citation.
Okay, all right. Thank you very much, sir. We just want to appreciate our father, Alhaji Aziz Balatoye, again for his time and the valuable contributions and valuable messages that we forgot in today. And valuable responses to many of the questions that were asked, both on the platform and those that verbally asked. Thank you very much, sir. We'll be going on straight to the next session today, and permit me to introduce the speaker, Mr. Gali Aka. Mr. Gali Aka is the senior manager at KPMG Nigeria. He's having previously worked as a senior revenue supervisor at Lagos Internal Revenue Service a couple of years ago. He is a graduate of accounting from Crescent University. He's a member of Chartered Institute of Taxation of Nigeria, as well as Institute of Chartered Accountants of Nigeria. He had his MA in Taxation, Law, Admin and Practice from the Institute of Advanced Legal Studies, School of Advanced Study, University of London. So I'll be handing over the mic to our brother, Mr. Gali Aka, to take the next question.
Assalamu alaikum wa rahmatullahi wa barakatuh. Thanks a lot, Mr. Taiwo. And I thank the organizers of the program, the Mpaan chairman, as well as other members of the planning committee. It's my pleasure to join you today to talk about transfer pricing. And we thank Allah subhanahu wa ta'ala for making it, possible for us to have this session today. So I'm trying to project my
presenter. Salam alaikum.
Wa alaikum assalam wa barakatuh.
Yes, so yeah, we can see the presentation, it has come up, but can I please humbly request if you can do this in 45 minutes, is that possible?
Okay, I'll try my best, inshallah.
Okay, don't worry, I won't rush you so that we can also have some more time for Q&A.
Okay.
I don't intend to put you under undue pressure, but I'm sure you heard when Rivers past president Alhaji Razak Jayola said he has come purposely to listen to transfer pricing.
Okay.
So
Okay,
you are going to be lecturing our Rivers past presidents.
Yeah, may Allah make it easy.
Please go ahead.
Okay, so I'll be talking to us about transfer pricing, the prospects, challenges, and the way forward. So the outline of my presentation, we'll look at the evolution and importance of transfer pricing. We'll look at the current prospects and opportunities for professionals, accounting professionals within the society and outside. We'll look at the challenges and how to navigate regulatory complexities. Then we'll look at, the future trends. What are things that we expect to happen in the near future in the transfer pricing space? So let me just dive into the presentation proper. So looking at the evolution of and importance of transfer pricing. So I think to start with, it's important to know what transfer pricing is. And transfer pricing means a lot, or means people have different interpretation of what transfer pricing is. If you ask a layman, for example, what transfer pricing is, they'll simply tell you that it's the price at which goods or services are exchanged between two parties. So there won't be any distinction as to who those parties are. So if you look at from a management accounting perspective, and I'm sure a majority of our members would have gone through this in their one way or the other, maybe doing writing ICANN or when they were studying accounting in school. So under management accounting, we have the concept of transfer pricing, where based on a particular book that I've cited below, is the amount charged by one segment of an organization for a product or service that it supplies to another segment of the same organization. So you would find that concept within the accounting, space. And I think also it's one of the questions, topics that are being treated under management accounting. So, but along with it, there's also series of misconceptions on what transfer pricing is. I've cited a particular paper, guardian.co.uk, that says transfer pricing is the biggest tax avoidance scheme of all, and the government must insist on companies being more transparent. So yes, transfer pricing can be used for tax planning purposes. It could also be used for tax avoidance purposes. So from a tax and transfer pricing perspective, transfer pricing is the pricing between associated enterprises. So the word associated enterprise is very important. So when you're talking of transfer pricing from a tax perspective, the entities transacting must be related parties. Then it's the pricing between associated enterprises of transfer of goods, services, and intangibles in accordance with the arm's length principle in a cross-border context. So historically, transfer pricing has always been applicable to transactions between members of the same group, but in different tax jurisdictions. But more recently, we see transfer pricing regulations or legislations being applied to domestic transactions between entities that are related in the same country. So transfer pricing is not just an anti-avoidance measure from where we are looking at it from a tax regulatory perspective. It's not just a tax planning tool, it's also a tax compliance obligation. And we'll look at what the compliance obligations are in subsequent slides. So I just want to paint this scenario so that people can, start thinking of what transfer pricing is and the implication from both a government perspective and multinational perspective. If we look at scenario one, where we have a manufacturing company and a distribution company situated in the same country, and compare it with scenario two, where we have a manufacturing co in a different country, while we have the decision co in another country. So let's look at maybe China and Nigeria, for instance. A lot of people import products from China for distribution in Nigeria. So let's assume that a company that manufactures widgets is based in China, and it has a related party based in Nigeria that distributes the products in the Nigerian market. So the question is there a transfer pricing issue? And what are the risks and issues faced by the governments and multinationals that are operating both in China and in Nigeria? So the first issue is about pricing. And pricing would eventually affect the balance in the allocation of taxing rights between China and Nigeria. So there is vested interest from the Chinese tax authorities. There's also interest from the FIRS to say, how is the pricing of these products going to impact the tax base of the distribution company in Nigeria? The Chinese tax authorities will be interested in knowing how the price charge for the sale of widgets is going to impact their taxable base in China as well. And that's why, countries have implemented transfer pricing requirements in their tax laws. So in Nigeria, we have the transfer pricing regulations. In some countries, transfer pricing rules are passed by the legislator. So they have transfer pricing legislations in those countries. So looking at the evolution, so the first concept of transfer pricing was reviewed by the work of Michel B. Caro in its book, the work he did for the League of Nations in the 1930s. That was when the arm's length principle was first mentioned. Then subsequently in 1963, the arm's length principle became a requirement under the Organization for Economic Cooperation and Development, OECD, Model Tax Convention. So you find that in Article 9. Article 9 talks about associated enterprises. Then moving forward to 1963, the United States released the first ever transfer pricing regulations, which introduced the comparable and control price method and other traditional methods of testing the arm's length nature of related party transactions. So if I may pause here briefly, the comparable and control price method simply means comparing prices of one product to the other. So I'll give you an example. iPhone manufacturers iPhone and sell to, let's say, distribution centers in Nigeria to sell in the Nigerian market. Let's now assume that iPhone also sells the same brand of iPhone to third-party distributors as opposed to its own distribution, related party distribution outlets in Nigeria. So what comparable and control price method is looking at is the prices at which Apple, based in US, is selling that product to his own distribution center in Nigeria, and to compare that price with the price it's selling to a third-party distributor in Nigeria. So that's the way comparable and control price method works. If we look at the oil and gas sector, for example, the regulated price for petroleum products also meets the criteria for comparable and control price method. So cost plus method is something that accountants are used to. So it's mostly applicable to services and sale of goods. So you make a product and you add an arm's length markup to the cost of those products and you sell in the market. So if you have a manufacturing company that sells products to a related party within or outside its own jurisdiction, let's say the cost of manufacturing is 100, it can add an arm's length markup of 5%, depending on the functional profile of the manufacturing enterprise. So we also have the resale price methodologies. So resale price is like a walk back to say how much is this product, how much is this sold in the marketplace, and how much margin are distributors or retailers selling similar products, how much are they making? So that margin is then deducted from the sales price to determine what the cost price is. So it's a walk back approach in establishing the transfer price for a sale of products. So fast forward to 1979, the OECD also did extensive work on transfer pricing. And post 1979, we have also the UN adoption of the arm's length principle in Article 7 on associated enterprises. We have the first OECD guidelines in 1995. Then we have subsequent updates to 2022. So the recent TP guidelines is the 2022 guidelines. Then we also have the 2013 UN TP practical manual, which is simplified majorly for developing countries. And we have subsequent, editions in 2017, and the latest edition is in 2021. So now, why is transfer pricing? Why is it important? So I mentioned something earlier that states need to protect their tax base, and I'll demonstrate that with a little computation in subsequent slide. So states want to protect their tax base while not impeding cross-border trade and foreign direct investment. So hence, the general acceptance principle has been or is being adopted. So everyone, if the tax authorities tell you that we want you to adopt the arm's length principle, and they are not using best of judgment to assess a company that is a member of an MNE to tax in Nigeria, then it's fair. They are not, by that way, they are not impeding any cross-border trade or foreign direct investment, because they are just being fair. They want the profitability of the Nigerian entity to be comparable to what similar companies are earning in Nigeria. So states want, they have an increasingly establishing robust legislative and administrative framework to deal with transfer pricing issues. 30 years ago, only a few countries had transfer pricing regimes. So this number has grown and continues to grow. So Nigeria had its own transfer pricing regulation in 2012. 30 years ago, Nigeria didn't have, but we had a provisions in the Company Income Tax Act, I think section 22 on artificial transaction, that allows, empowers the FIRS to make adjustment to the profit made by a company that has entered into a transaction they think is fictitious or has not been conducted at arm's length. So among other things, so states are also providing access to advanced pricing agreements just to ensure that there are higher level of certainty. So what APA means in essence is that a taxpayer is going to enter into an agreement with the tax authority to fix the pricing of a particular related party transaction. So in as much as the company complies with that agreement, the FIS is not going to make a transfer pricing adjustment to the pricing of those transactions, and it will lead to additional tax liability. So I want to explain this scenario to drive home the point of why transfer pricing is important. So if we look at parent company, parent entity in country A, as well as the subsidiary in country B, and look at their consolidated results. So total profits, if you look at the row one, total profits on tax return in millions of dollars is 700 for the parent entity and 300 for the subsidiary in country B. And the consolidated taxable profit is 1,000. The tax rate in the parent country's parent entity's jurisdiction is 40%, while the tax rate in the subsidiary country is 10%. And the implication is that in the group will be paying 280 in country A, while they only pay 30 in country B. And that leads us to a 310 tax liability for the entire group. If we look at scenario 2, there has been a shifting of profit. So it could be either the parent company undercharging for the product it's selling to its subsidiary in country B, or the subsidiary providing services and overpricing those services to the parent company. So we can see that under scenario 2, profit has shifted. So we now have profit of 700 sitting in country B, while the parent company is reporting 300 in country A. So in this instance, the group is taking advantage of the lower tax rate in country B. And effectively, the group is paying 190 as effective tax on a consolidated basis. And the effective global effective tax rate is 19% from the 31% we had in scenario 1. So this is exactly why transfer pricing is important to countries, because without transfer pricing regulations in place, multinational enterprises would have the freedom to move profits anywhere in the world. And that's why we have a lot of multinationals having entities in tax havens. You have entities in Jersey, in Guernsey, in Dubai, and other lower or no tax jurisdictions. And they will put services, they will put functions in those jurisdictions so that revenue will continue to go to those jurisdictions with little or no taxes. And that's why we had the base erosion and profit shifting project that was inaugurated in 2013, and final reports were issued in 2015 rather. And since then, there has been series of implementation that has also impacted Nigeria. More recently is the BEPS 2.0 that deals with digital economy, where entities do not necessarily need to have a physical presence in Nigeria, but they will generate significant, revenue from Nigeria. So moving forward, if we look at the legal basis, the evolution of transfer pricing in Nigeria, I know I mentioned that the first regulation we had was in 2012. So that was the first regulation, and we had a revision in 2018, which was aligned to the OECD BEPS Action 13 report that deals with transfer pricing and country-by-country reporting. So what are the major differences between the 2012 and 2018 regulation? So the 2018 regulation bifurcated the transfer pricing documentation requirements into two. So we had the master file and local file. And there is more clarity as to what information the tax authorities expect companies to have in their transfer pricing documentation. And I will tell us what transfer pricing documentation is all about. So there are other differences that the 2012 regulation does not contain any specific penalties for non-compliance with the compliance obligation. So the regulation simply said the Principal Act, the penalties in the Principal Act will be applied for non-compliance with the 2012 regulation, whilst in the 2018 regulations, we had significant penalties for failure to comply in the tune of 10 million and above. So for Nigeria, the 2018 regulation is the current legal basis for transfer pricing in Nigeria. But before then, before the 2012 and 2018 regulation, the tax authorities have always relied on the artificial transaction provisions in Section 22 of CETA and similar provisions in the PITA and the Petroleum Profit Tax Act. So what are the applicable materials or documents you can rely on when providing, maybe if you are a tax manager in your company or you are a tax consultant providing transfer pricing services? These are apart from the TP regulation, these are other documents that you can rely on. So the regulation is 2018 in particular is modeled on the OECD transfer pricing guidelines 2022. So they are similar except for a couple of provisions that were not domesticated. I'll give you an example. There is a provisions on low value added services, which is a safe harbor. So if you conduct transactions that are routine, maybe you provide tax, accounting, HR, IT services, low risk IT services to a company, and that service is not core to their operations. So let's say you have a manufacturing enterprise, for example. HR services is not their core function. Maybe they manufacture, beverages. So in that instance, you're deemed to be providing low value added intergroup services, and you can apply a safe harbor markup of 5%. So that particular provision was not adopted in the 2012 and the 2018 regulations rather. So those are the differences. But in practice, taxpayers still rely on the OECD guidelines since it's an applicable piece of document mentioned in the 2018 regulation. So we also have the UN practical manual for transfer pricing for developing countries. It's a simplified, let me put it this way, it's a simplified version of the OECD guidelines. So you have more examples and more explanation. Then we have provisions, the Article 9 in the UN and OECD model tax convention, and you find it in all the double tax treaties that Nigeria have with other jurisdictions. So there is a condition, even though the 2018 regulation states that you can you can use the UNTP practical manual or the OECD transfer pricing guidelines in putting together your transfer pricing documentation, or let me put it, compliance report. If there is any inconsistency between the provisions in the OECD or UNTP practical manual and the TP regulations itself, then the provisions of the TP regulations would prevail. And I'll give you an example. There is a provision in section 7.5 that limits deduction of royalties to 5% of EBITDA. So if you license maybe a technical, a know-how, for example, in manufacturing a product, a trade secret, and you want to pay royalties to the foreign related party, the licensee, the licensor, rather, the regulations limit the amount you can pay. You can go ahead to pay 100%. Maybe you can pay 5% of your revenue, but you can only get 5% of EBITDA as a tax deductible expense for the purpose of, your CIT computation. So that's obviously a regulatory restriction in Nigeria and is not in line with the arm's length principle. So, and this is one of the controversial areas of transfer pricing in Nigeria, because one will wonder to say, even though FIS they've been empowered in the FIS establishment that to make provision, to make regulations, are they then empowered to determine what expense is deductible or not, and to what extent such expense is deductible? So those are one of the gray areas or controversial areas in transfer pricing. As we speak, based on experience, I have not seen any taxpayer challenge that provision at the TAT yet, but it's an area. I even wrote an article on it, on inconsistencies in the transfer pricing and country by country implementation in Nigeria. So it's an area that I will encourage people to look out for. So before you can apply transfer pricing to any taxpayer in Nigeria, to any company in Nigeria, you have to establish that there is a connection. So the regulations talks about connected taxable persons. It talks about connected persons rather. So persons are deemed to be connected if one person has the ability to control or influence the other person in making financial, commercial, or operational decisions, or there is a third party who has the ability to control or influence both parties in making financial, commercial, or operational decisions. So connected persons can also be defined as associated enterprises based on what you'll find in the OECD in the Article 9 of our DTTs and OECD model tax convention, where two enterprises are considered to be associated when one party participates directly or indirectly in the management control or in the capital of the other, or the same person or persons participate directly or indirectly in the management control or capital of both entities. So the connection for transfer pricing to be applicable is very wide, and I'll give you an example. Ordinarily, when we look at control, we will look at entity A having maybe over 50% of the shares in entity B. Then, or influence, maybe based on IFRS, you have significant influence. Maybe you have 40% shareholding is deemed to be significant enough for you to be able to influence the other company in making financial, commercial, and operational decisions. And we've seen in practice where a foreign entity that owns 40% of a joint venture is consolidating that entity, whereas a Nigerian entity is owning 60%. So is who, at times, shareholding does not determine who has control. So this is very wide. And if we look at what management entails of control, I've seen in practice where if a company has a board member that also sits, for example, let's say I have a company in Nigeria and one of my board of directors is also a board of a bank that my company banks with. If I obtain a loan from that bank, or the bank buys the product I manufacture, for example, then we are deemed to be connected because through common directorship, which I think is a stretch, but that's the provisions of the law. And I've seen it in practice. I've worked for one of the largest telecoms company in Nigeria that had, a consortium of banks provide loans, and some of their directors were also directors in those banks, and we had to disclose the financial arrangement as a related party transaction in the transfer pricing documentation of the company. So we had no choice. So they were related to common directorship. So it's important that we take note of that in determining whether a company is exposed to transfer pricing or has transfer pricing obligations. So in the regulation, if you look at Regulation 3, these are the transactions that falls under the purview of transfer pricing in Nigeria. So provision of services, maybe accounting, auditing, IT services, manufacture, sale or purchase or lease of tangible assets, financial transactions, loan, guarantees, hedging, transfer, purchase, license, or use of intangible assets. So technical know-how, payment of royalties for use of trademark and trade names. So, and any other transaction that may affect profit or loss, or any matter incidental or connected with or pertaining to any of the other transactions that we've mentioned. So if we look at this, dividends is obviously out of it. Transactions between a company and its employee is also out of the picture. So what are the current prospects and opportunities in the transfer pricing space for us in Nigeria? So the first one I'll talk about is annual TP compliance. So if we look at the 2018 regulations, Regulation 13 speaks to preparing and filing a TP disclosure and declaration form. So these are two forms that are now filed on the transfer pricing portal, ATP portal. So the disclosure form is a form that speaks to the nature and value of related party transaction that a company conducts with its related parties, maybe in Nigeria or outside Nigeria. So a company is expected to disclose similar to your related party disclosures in your financial statements. So you disclose those transactions, you disclose the nature, you disclose the value. There are other sections of the report as well that speaks to the transfer pricing methods that you've used to, to test the arm's length nature of that transaction. Then you also have the declaration form. Now, declaration form discloses information about the ownership, principal activities, and the nature and related parties of that entity. So you expect to, provide information such as the name of the entity, principal officers, directors, the related entities, those that you are related, that the entity company is related to, via common directorship, via common parents, or via common holding entity, a parent-subsidiary relationship. So those are the kinds of information that you are expected to disclose in the declaration form. Now, failure to file a disclosure form is penalized at 10 million and 10,000 for every day in which the failure continues. Similarly for declaration form. So declaration form, once you file, if there are no changes in management and control or the business, if there is no restructuring, then you don't need to file a declaration form in subsequent years. However, if there are changes, you then need to update your declaration form. Changes as little as resignation or appointment of a new board member, then you have to update your declaration form. If you don't do that, then the penalty is 25,000. Then another compliance obligation is the TP documentation, which I mentioned earlier that it has been bifurcated into a transfer pricing master file and a transfer pricing local file. So my master file speaks to the group structure, the group as a whole. So the financial arrangements, the intangible assets, who owns the brand name, who owns the formula that the group is using to manufacture products. For example, if we look at the Coca-Cola brand, who owns the Coca-Cola brand name, who owns the formula, where is the entity situated? You understand? Those are the sort of information pertaining to the group as a whole. Then the local file speaks to, entity specific. So if Coca-Cola has a subsidiary, maybe NBC, Nigeria Bottling Company, is a subsidiary of Coca-Cola. And, if NBC needs to prepare a local file, it will be specific to its own situation in Nigeria, and NBC will be reporting transaction between itself and other members of the group. So any transaction within the group that does not pertain to NBC will be excluded from the local file. So it's country specific. Now, I've also put the country by country reports and notification here. So it's one of the compliance obligations. If you remember, I mentioned that the 2018 regulations adopted the provisions of the BEPS Action 13 report released spearheaded by the OECD and G20. So the adoption was done with two regulations. So we have the revised 2018 regulation for transfer pricing. We also had the income tax country by country reporting regulations 2018 that then requires entities that are members of an M&A group. So if we look at Nigeria, we have just few M&A groups because of the revenue threshold. So for you to comply, for your company to comply with the C/C regulations in Nigeria, they need to meet the revenue threshold of 160 billion in Nigeria. So if your group is headquartered in Nigeria, if we look at the Dangote group, for example, the country by country reports will be prepared and filed in Nigeria by Dangote Industries Limited. And the revenue threshold that, you know, such company will be looking at is the 160 billion naira threshold. So if your company is just a constituent member of an MNE group that is resident outside Nigeria, let's say in the UK, for example, or in the Netherlands, then the reference point is 750 million euros. So if I know people will be wondering, 160 billion and 750 million euros, the threshold are not, you know, similar considering the fluctuation in exchange. So there's an agreement, there's a consensus in the Action 13 report that the exchange rate to use is as of January 2015. So we still maintain the 160 billion for the threshold in Nigeria, and this will be reviewed, you know, in the future. So any constituent entity that is group meets the 160 billion threshold for MNE's headquarters in Nigeria, or the 750 million euros for MNE's headquartered in Europe, or $850 million for MNE's headquartered in the US, then they need to file a C/C notification on the last day of the reporting period of the MNE group. So for example, if the MNE group's year end is 31st of December each year, then the Nigerian entity will need to file a notification with the FRS on or before 31st of December. And the basis of determining whether you meet the threshold. So if we take 2024, for example, you have to look at the consolidated revenue for 2023, December 2023, to determine if you meet the threshold. If you meet the threshold in December, consolidated financial statement for December 2023, then you file notification in 2024. Then you could have situations where the group's year end is December, but the Nigerian entity's year end is, let's say, March. So you still have to follow the group's year end. Then the C/C report is to be filed only by the ultimate parent entity. So if your company is not the ultimate parent entity, then the company is not required to file the C/C report with the FRS, except there is a secondary filing obligation. And there are conditions for secondary filing obligation. One of the conditions is that there is no C/C requirement in the jurisdiction of the ultimate parent entity. And the ultimate parent entity has not nominated a surrogate parent in another jurisdictions that file C/C, that have C/C reporting requirements. Second condition is that there is a systematic failure. So there is C/C obligation in such jurisdiction, and there is exchange of information relationship between Nigeria and that jurisdiction. However, there is a systematic failure, and that systematic failure has been communicated to the FRS. So because of one reason or the other, the jurisdiction of the ultimate parent entity will not be able to share that report, a copy of the report, with the FRS in Nigeria. Then the constituent entity in Nigeria has that obligation to make that secondary filing. So what that entity is required to do in that instance is to obtain a copy of that report and file with the FRS. So systematic failure, I'll give you an example, maybe Ukraine and Russia. So because of the war in Ukraine is, you know, more affected, so these things may not be possible. They may not be able to share a copy of the C/C report with the FRS. Russia too, they may or may not be able to, depending on how the war has impacted, you know, their revenue authorities. And the fact that, you know, a lot of countries have severe relationship with Russia. So moving on, there are also, you know, opportunities for transfer pricing advisory, where maybe companies want to enter into related party transactions and they would like you to advise them on the arm's length price. So they want an element of, planning, because in transfer pricing analysis, the benchmark would always have a range, and you'll be able to advise your company on whether to move towards the upper quarter or lower quarter or stay within the median. So there's an opportunity for planning. Then there's this NSE opinion. We have set rules for entities that are listed. So if principal officer, maybe a director, is entering into a related party transaction with the listed entity, then there are some requirements. So the company is expected to get an independent opinion that the transaction is not prejudicial to the interests of the listed entity. So that's another opportunity. There's an opportunity to conduct transfer pricing health checks. In Nigeria, transfer pricing audits is rigorous. It has been on the increase, and the liabilities could be could be very huge. One of the judgments we had with Prime Plastic Chem, the Prime Plastic
the paper presenter.
Yes.
I think you have 10 minutes, please.
Okay. So let me run through. Thanks for the information. So there's an opportunity for TP support, dispute resolution as well. Then there's also an opportunity for technology, particularly those that are tech savvy. So operationalization of TP support, where the TP calculations is embedded in the existing ERPs for companies that engage in related party transactions. So prospects. So recently, last year, towards the end of last year, the FRS issued a draft guidelines for advanced pricing agreements, which is APA. So once that is finalized, to get commentaries from consulting firm, once that is finalized, I think it will be rolled out, and that there are prospects in that aspect for people. Economic valuation services as well. Majority of the valuation I've seen in practice have been performed outside Nigeria, particularly by parent entities of companies that, parents that have subsidiaries in Nigeria. So majority of those valuations are not done in Nigeria. And there's opportunity in that space if people can build capacity in that aspect. Then technological solutions, use of AI and use of, deploying functional analysis interview. There are aspects of typical compliance that could be digitized. So if you go through the regulations, look at the requirements, one of the areas I mentioned is the functional analysis interview, where you could actually use AI to conduct the aspects of the work, where people will log on, they will ask specific questions and following questions to understand the functions performed by each entity with respect to a particular related party transaction. Then what are the challenges and how do we navigate the regulatory complexities? So limited expertise, like I said, transfer pricing is still, even though it has been implemented in Nigeria since 2012, is still relatively young. So we have limited people. So for example, when we have, attrition based on relocation, JAPA, it's difficult to, get transfer pricing professionals to come in, those that have experience. So we then need to recruit, train graduate trainees and start training them on TP. Then data availability and reliability. So when you're trying to conduct benchmarking analysis to support a particular transaction, you hardly find comparable companies in Nigeria and within the African space, due to the fact that majority do not have obligation to file, or their records, financial records, are not publicly available. So we try to use regions that have similar economies to Nigeria. So maybe Middle East, Eastern Europe, Eastern Europe, and Africa. So those are the regions that we typically rely on. Then discrepancy in interpretation. So you have situations where, like I mentioned, Regulation 7.5, limiting the tax deductibility of royalty payments to 5% of EBITDA. It contradicts the provisions of, I think, section, is it 26 or 27 of Company Income Tax Act, which allows you to, deduct any expense that meets the rent test. Then capacity constraints, we also have a lot of dragging audits. You could have all these audit drags for 12 to 18 months, some for 24 months. So FIS needs to, recruit more people and train people. Then cross-border collaboration. So the challenge you have with this is mutual agreement procedure is cumbersome. So if you have an adjustment, FIS makes adjustments in Nigeria to the transaction between a Nigerian entity and a UK entity, there won't be any automatic corresponding adjustment by the HMRC in the UK. So the taxpayer in the UK would have to approach the HMRC, and HMRC would have to agree to the FIS's adjustments. If they don't agree, then there is an element of double taxation, juridical double taxation in that instance. And the only way that can be resolved is when there is mutual agreement procedure between the HMRC and the FRS. And Nigeria has not subscribed to any binding mutual agreement procedure. So it could take up to 3 to 5 years to resolve such tax disputes. Then we have lack of judicial precedents in Nigeria to rely on. Like I said, we only have one case, Prime Plastic Chem, that deals with application of comparable and control price method. So it states the condition of the application of COP method, and I think the liability was around that 2 billion naira adjustment for the taxpayer. So it really doesn't provide more clarity on controversial or gray areas within the regulation. The second judicial precedence we have is with respect to C/C regulations in the case of Checkpoint and the Federal Inland Revenue Services, where the TAT held that the 2018 C/C regulation was unconstitutional and void, and that the FIS cannot apply the penalty assessment they issued on the taxpayer. And why they consider it to be unconstitutional was because the regulation was not, done by a properly constituted FIS board. So during that period in 2018, the board had been dissolved and there was no new board. So, and the law does not permit the board to delegate that, that power or that authority to another body. So, and that has an implication for transfer pricing regulations itself, the 2018 regulation that also, imposes significant penalties for non-compliance. But as we see it, our clients continue to comply, because even though the judgment exists, FIS could still rely on other provisions of the CIT, for example, artificial transaction provision, to make adjustments related party transactions. So how do we navigate regulatory compliance? So we need to identify transactions under the scope of transfer pricing regulations. We need to, conduct a risk assessment of our intercompany transactions. So we need to check to see if we are conducting that related party transaction in line with the arm's length principle, in line with the transfer pricing policy that we may have put in place, in line with any regulatory restrictions. Then prompting filing of transfer pricing returns. So transfer pricing returns are due 6 months after the year end of each entity. So you are meant to file it along with your company income tax returns, except for a new company who then needs to file within 18 months of incorporation or 6 months after year end, whichever is earlier. Then accurate and extensive record keeping of source documents. We've seen in practice that FIs issues a notice of audit and taxpayers are unable to provide invoices. For example, services are being provided by a foreign company to a Nigerian entity, and FI says, oh yeah, give me the cost, makeup of this cost, and let me see the markup portion. The entity is unable to pull out those records. So you can't substantiate that transaction. So it could lead to TP adjustment and ultimately penalties. Let's ensure that we have a contemporaneous TP documentation in place. The FIS could request for TP documentation anytime after 6 months after the end of the company, and the company would have 21 days to make that documentation available or be subject to a 10 million penalty. Then we should also, for our companies, let's conduct periodic internal reviews to ensure that we continue to, apply the arm's length principle. We continue to be consistent with the provisions of our transfer pricing policy, and we should also proactively keep abreast of regulatory changes. So, like I mentioned, changes from 2012 to 2018, which has significant penalties, and any other regulatory changes. For example, the EBITDA restriction for interest expense through the Finance Act. So those are changes that were not directly made under the 2018 regulations, but were effected by the Finance Act. So the future landscape, trends and innovations. So like I mentioned, digitization, use of AI is an area. So if we have people that are tech savvy, then it's an opportunity for them to invest and create solutions in that aspect. Then dispute resolution is another area, particularly when we have APAs, is another form of ensuring that there is certainty and to avoid tax disputes with tax authorities. Then in the aspect of supporting taxpayers when FIs has issued their transfer pricing audit reports, or going to the TAT, going to the courts to defend the client's position. Then opportunities also in the area of BEPS 2.0, which has to do with the global minimum tax. Then there's an aspect under Pillar 1 that has to do with transfer pricing. So what the OECD is trying to do is to set a margin for baseline marketing and distribution activities. So there will be a reallocation of profits from large corporates, large MNEs to Nigeria if they qualify, as well as ensuring that entities that are doing baseline distribution earns a particular target operating margin. So those are part of the recent trends within the tax and tax transfer pricing and international tax space. So I will pause at this point and allow participants to ask questions. Thank you.
All right, thank you, paper presenter, Mr. Gali Atta. Jazakumullah khairan. Thank you very much for taking us through the journey of transfer pricing, both from a conceptual perspective, but also from experiences within Nigeria. I think it started by demonstrating that TP is not just between entities in different jurisdictions anymore, but now TP is also relevant to companies dealing with each other within the same jurisdiction. And then it took us through the evolution of transfer pricing and demonstrated why it's important, the rationale behind it, and various efforts by tax authorities across the globe in trying to put together a TP framework. He also shared his wealth of experience talking about the prospects and opportunities in TP planning, TP strategy, especially digitization and the use of technology, what technology can do for us within this space. But in all of that, he also told us about the challenges, either from a regulatory perspective, from an expertise and resource constraint issue. Also, the fact that lack of evidence or lack of data, comparable data across jurisdictions. So he's talked about a lot of things. I'm sure that when we go into the Q&A session, there'll be opportunity for him to shed more light on those things. But for now, I would like to once again invite my sister to come and help us share some additional insights on this topic. That's Mrs. Olubusayo Amo, to come and contribute to this paper, share from our own experience, or are there other things that she would like to bring into the conversation? So our sister, Mrs. Amo, you have 15 minutes to make your contributions to this paper. Thank you.
All right, thank you very much. Assalamu alaikum wa rahmatullahi wa barakatuh once again. And thank you very much to Gali for the insightful presentation on transfer pricing. This is definitely a very important area, and it has been evolving, but one may ask, okay, so why transfer pricing? Why is it such a big deal? Well, it's such a big deal because over time, you've seen instances where a lot of organizations in first world countries come to the less developed countries and maybe less tax savvy countries, establish businesses there, and through different ways and means take out profits which may not necessarily be declared in those countries and this usually happens through increasing related party transactions. So Gali has tried to explain what related party transaction means. So you have transactions between two people that are connected. And so if you're able to inflate prices between your related party in a jurisdiction that has lower taxes or that is not very tax savvy or very developed, you'll be able to, that organization in a less tax savvy or less developed country will be able to recognize huge expenses which it's actually paying to a related party, and that way they'll be reporting very minimal, either minimal tax payable within the country or just huge expenses that ordinarily should have stayed within that country. So at the end of the day, what you have is you're getting huge economic benefits within one jurisdiction, but you're not returning the favor. So you're not actually giving back the taxes or the relevant levies that you should be giving back to that economy where that has helped you to generate that level of profit or revenue. So that's actually why transfer pricing has come to play, to say, okay, if you're connected, you have to transact at arm's length. So this arm's length principle is actually very, very central to the concept of transfer pricing. And what does it mean? It just means that you should, if you're a connected party, you need to have transactions with any related party at the same price that you would have with a third party. So what transfer pricing tries to do is to look at transactions between connected persons to say, okay, party A and party B are connected. Party A sold goods, raw materials, or helped party B to source goods, raw materials, or provided licenses, and so on to party B. Is this what a third party will charge party B if they were to enter the same transaction with them? So would an external party, would another company that is unrelated to party B, would they charge the same amount, or has party A inflated the price so that it's able to take out profits top line rather than bottom line? So top line is before your taxes, before you even determine what your profit is. But bottom line is, okay, that's like dividends and so on. So what some companies try to do is to take out profits top line through inflated prices. So transfer pricing actually helps to address this issue. So that arm's length principle is actually very important. So we have to actually hold it very tightly when we're looking at transfer pricing. So when I was talking about taking out profits top line, you have instances where tax authorities are actually very focused on loss-making companies. So if you are a loss-making company in Nigeria, for example, so you've been making losses consistently for 5 years, 6 years, 7 years, the tax authorities will take a closer look at your books, say, if you're making losses, then why are you still in business? So they'll put you under scrutiny. They want to find out what exactly is going on. So what you found in some instances is that the investors, the foreign investors have actually taken out profits top line. So that way, the company is only paying very minimal taxes or no taxes at all. So at the end of the day, they're always reporting losses. And of course, the first principle of business is to make profit. So the FRS is going to ask, your tax authority to ask you, so why are you in business if you continue to make losses? That means something is amiss. So that's also, so transfer pricing is also involved in this kind of situation. So the FRS may actually launch a TP investigation on such a company, especially if they have foreign related parties or foreign owners, to see if they are inflating prices between themselves in such a way that they are only recording very minimal profits in Nigeria, even though a huge part of their profits are revenue are actually being generated in Nigeria. So the idea is to ensure that adequate taxes are paid where economic benefits are actually derived. And then you may also ask, so why is transfer pricing largely concerned with multinational companies? Why is it a subset of international tax and not necessarily local taxes? So the truth is that for local companies, even if you have two related parties that are local entities, if one entity increases its expense, what constitutes an expense for one company will constitute revenue for the other company within the same country. So even if you increase your expense in one company, and the other company will receive it, but they're still in Nigeria. So the company that is receiving the revenue will still pay the taxes on that amount in Nigeria. So that's why, to a very large extent, transfer pricing focuses on multinational companies and not necessarily two related local entities. So you may also wonder, okay, so how are you able to determine the prices, what a third party would charge for a particular transaction? So one thing about transfer pricing is research is actually very central to transfer pricing. So lots of research is typically done, and some information may be applicable, may be available in public domain to be able to get what third parties would charge in a similar situation. But you also have softwares, databases and companies that have specialized in this research to give you a range of prices that will be applicable in different jurisdictions for different transactions. So you can actually leverage some of those resources, those databases, to get information on what third parties would charge with a similar company, and what third parties would charge for a similar transaction. And that's where the expertise of consultants and specialists come in, because subscribing, so you have to subscribe to such databases, and I mean, subscribing could be pretty expensive. So you have consulting companies making those investments, and then as an individual company that wants to maybe get such information, you can get your TP study and materials, your TP study done by those consultants who will leverage such resources to determine what is obtainable in the open market for such transactions. Then in the course of Gali's presentation, he also spoke about the digital economy. So we've broached the fact that, look, there's a risk of non-taxation in certain jurisdictions or low tax in certain jurisdictions. What we found over time with digital economy is that you can just sit in your country, Canada, Nigeria, US, wherever, and transact in another country just on your laptop. And maybe especially if you're providing services and so on, or you're providing a software and so on, and you don't get taxed, sometimes even in your own jurisdiction, and you also don't get taxed in the other jurisdiction. So this leads to tax leakages. So what we found now is that there's a lot of focus on the digital economy, and countries are modifying their double tax treaties to accommodate these digital transactions. So for example, in Nigeria, through the Finance Act, we've been able to introduce the significant economic presence, where if you actually get to a particular threshold of transacting in Nigeria, then you're going to be liable to taxes. And then there are even some specific transactions that once you're involved in them, technical services, management services, consultant services, you're definitely going to be liable to tax in Nigeria, because it's very easy for you to provide these services outside Nigeria to a Nigerian resident and actually not pay any taxes. Then we've also seen, still on that digital economy, we've seen instances where we've seen the Finance Act update certain laws in Nigeria to help appointing non-resident entities as agents of collection of taxes, VAT, for example, and also requiring these non-resident companies to register for taxes in Nigeria. So we have instances, cases like Uber, Bolt, and so on. So they're not in Nigeria, but they're making huge revenue from Nigeria. So what is the mechanism for actually ensuring that they get adequately taxed within the jurisdiction where they're making so much revenue and profits? So when you talk about transfer pricing, you have expense areas that actually draw the scrutiny of tax authorities. So once you're a multinational company, there are just certain areas that, even from a normal tax audit, the tax authority, the tax officials would actually pay attention to these areas, and they include services, financial transactions, intangible assets. So if you're providing licenses or providing services to your related party in Nigeria from UK, US, or wherever, or Dubai, the tax authorities actually pay a lot of attention to these kind of transactions. They would request agreements, they'll review invoices, they review a lot of things to ensure that whatever you are charging is actually what is obtainable in the open market, and you're not just inflating your fees and prices so that you pay minimal tax in Nigeria, and you've also taken out your profit top line through your license fees, royalties, and so on. Then Gali also spoke about challenges.
Sister, just 3 minutes more, please.
Okay, that's fine. So Gali also spoke about challenges. For me, wherever you have challenges, you also have opportunities. So one of the challenges that Gali mentioned is resources. So you don't have a lot of people that are specialized in transfer pricing. So what you find is sometimes the tax authorities are overwhelmed, and even the consulting firms that specialize in transfer pricing sometimes also get overwhelmed because of resources. So this is one area that I think opportunities are bound for professionals, and I'd like to implore our members to look into this field, into this subject matter, and try to develop their expertise. I mean, there are professional exams that are available for members to take. You have for example, you have the Advanced Diploma in International Taxation. They actually have a paper that focuses on transfer pricing. They have a paper that focuses on international taxation. So if you're able to take some of these exams, it increases your chances of, or it increases your knowledge, your exposure, and your chances of being able to get jobs, opportunities that would give you the grounds to grow your career in transfer pricing, because this is a subject matter that has continued to grow over time. And I think we can't say we don't have opportunities in Nigeria, or it's only abroad that we have opportunities. So Nigeria is definitely a developing country, and there are a lot of areas that are not fully mature, and this is one area, like Gali mentioned, that is, even though it was introduced since 2012, it's still growing, and there are huge opportunities for us, for members to grow their career and their expertise in this area and be the better for it. Thank you very much. Assalamu alaikum
Okay.
wa rahmatullahi wa barakatuh.
Wa alaikum assalam wa rahmatullahi wa barakatuh. Okay, thank you very much, Sister Busaya, for those very wonderful additions, contributions to the original paper. Clearly, this is an area that you are very knowledgeable and passionate about. So we can only pray that Allah subhanahu wa ta'ala will reward you and make the knowledge very beneficial to you. We also want to thank our brother Galiaka for earlier presentation that he has made. At this point, we will go into question and answers. Just like I said during the first paper, I've already thanked both the speaker and the contributor on your behalf, so you don't need to thank them. Please go straight to your questions, make the questions very brief and straight to the point. Before I see a couple of hands up, before I take those two questions, I think there was one question on the chat box. Let me just read that out, and then maybe Brother Gali Aka can take that question, and it is from Dauda Yakubu. Is that at what point do taxpayers submit TP documentation despite filing TP disclosure and declaration? Then the second part of the question is, in the absence of a TP audit, can the FIRS raise additional assessments based on TP returns filed?
Okay.
Yes.
Thanks, Mr. Oladile. So I'll start with the second question. So an adjustment cannot be made until an audit is carried out by the FIRS. So there has to be an audit. They have to establish that something is wrong before an adjustment can be made. Then to the first question, the TP documentation is not to be submitted until it is requested for by the FIRS. So the provisions of the law is that you prepare it, you keep it in-house. If the FIRS wants it, they will request for it. And once they request for it, you have 21 days to provide that documentation to the FIRS. Now, that request cannot be earlier than 6 months after the year end in which the documentation relates to. So, for example, the TP filings for 2023 financial year will be due by June, end of June for a December year-end company. Then FIS cannot demand for the 2023 TP documentation in January, February, March until after June. So once they make that demand in June, then you have 21 days. Then I didn't mention this, there is like a partial exemption. So if the value of related party transaction is not more than 300 million naira, then a company may choose not to maintain a TP documentation. But that does not mean that the FIS cannot come back to ask for it. So if the FIS comes back to request that the entity prepares and submit a TP documentation, then the entity would have 90 days to submit that TP documentation to the FIRS.
Okay. All right. Thank you very much for that insightful answer. So I'll call on our colleagues who have raised their hands. We will take 3 questions. We will take questions from 3 members. Please make your questions very brief. And then for those first 3 sets of questions, the paper presenter will tackle them. So may I call on Abubakar Isiaq to ask the question?
Yeah, good afternoon, sir. Assalamu alaikum.
Wa alaikum assalam.
Please, my question is, does transfer pricing applies to all companies, so or only listed companies? So, for example, now some local companies may have intercompany transaction. Does it applies to them too, or it's just only applies to only listed companies? That is one. So the second one is, can we please have maybe direct contact of the resource person, maybe their LinkedIn handles or email for further questions?
Okay.
So
okay, all right, thank you. That will be addressed shortly. Brother Fatai Abdul, go ahead.
Assalamu alaikum. Assalamu alaikum.
Wa alaikum assalam wa barakatuh.
Yeah, please, can everybody hear me, please?
Yes, loud and clear.
All right. I have a couple of questions, and I'll be very brief about them. The first one is concerning the definition of connected persons. Vis-a-vis the situation in Nigeria, or say a number of people who are politically exposed, or let me just be more direct, like the example that the resource person gave us, where you have companies, directors of multinationals who have their own businesses that they run, or are also directors in other businesses. What parameter or threshold do we use as a basis in terms of while filing the returns of these entities? Say, for example, for the purpose of our discussion, say MTN, for example, that has directors that are also directors in other businesses and also have their own businesses. In situations where they do not, there is no intercompany transactions or control transactions, if you like, particularly for the purpose of declaration form, where you are expected to declare related entities. What parameter do you use as a yardstick to say, okay, this one does not fall in line, is not supposed to be disclosed while filing the TP returns of, say, MTN, for example, and the director has an interest there? Is there any parameter, or you just go ahead to list out all of the entities that each of the directors have interest in, whether they have control transactions with them or not? That is one. Then secondly is that, say, let's take, for example, Dangote.
Sorry, Brother Fatai, can you make it brief, please? Be brief about the question and direct.
Okay, so Dangote Group, for example, is it going to file? Is it going to prepare a TP documentation that is that will be local file, or is going to be a master file, given that it's a Nigeria-based entity with its headquarters in Nigeria, so to speak? Let me limit my questions to that. Thank you very much.
All right, thank you. Resource person, can you take those sets of questions and then we'll continue?
Thanks. Okay, so to the first person, does TP applies to all companies or only listed companies? So TP applies to all companies that engage in related party transaction, whether listed or unlisted. I know Busara touched base on it, and she said majority of the focus is on cross-border transaction. There are instances also where focus is on domestic transactions. For example, if you have an entity that have pioneer status, so that entity won't be paying taxes for 3 to 5 years, and if that entity deals with a related party that is paying taxes, then the FIs needs to look at them to be sure that they are not shifting profit to the entity with pioneer status. Then you could also deal with entity that is in the free zone entity. So TP applies to everybody, whether or not you're listed or not, in as much as you're engaged in related party transaction. Then the second question, definition of connected persons, whether there is any parameter. There's really no parameter per se. I know I mentioned that the definition of connected person makes it very, very wide, such that once you deal with an entity that has, even for family relationship, I've seen it in practice where FRS investigated a particular company. They said, you are trading with this entity. This entity is providing truck to this oil and gas company. And the owner of this oilage company is a brother, younger or elder brother of the person that owns the oil company. So why is it that you didn't disclose related party transactions between them? And they raised the assessment that for failure to disclose related party transactions. So in instance of MTN, in as much as you have the board, MTN is related to another entity through common directorship. They have to disclose that relationship. Now, if there is no related party transaction, so what they need to do is they disclose it. If it's a new relationship, they update the TP declaration form with that relationship. But in the disclosure form, since the disclosure form is for related party transaction, then they won't disclose anything because there is no transaction between them. Then on the second question for Dangote Group, so the requirement is to prepare a master file, local file. Now, the obligation to prepare the master file usually lies with the ultimate parent entity because the ultimate parent entity sits at the top and has an overview of all entities under its control and will be able to obtain all the information relevant for the preparation of the master file. So yes, the master file and local file will be prepared, even though the ultimate parent entity is not in Nigeria, even though the group is not resident in Nigeria, the Nigerian entity is meant to obtain a copy of the master file and the local file. So if the FIS requests for OTP documentation, the expectation is that you submit both the master file and the local file. Thank you.
Okay, all right. Thank you, Brother Aka, for those questions, for those comments. I think one of the participants also asked for your contact and details. I hope you can share that with the organizer so that you can pass it on to the participants, social media handles, or if you want to put it in the chat box too, that's at your discretion. Okay, before I go to Zinat Seriki, who has raised her hand, there are a couple of questions in the chat room that I would like to take. One is for Sister Busaya Mo, that you mentioned a particular advanced exam which can expose one to transfer pricing. Can you expatiate more on that? So, Sister, you have just 1 minute to answer that question. Thank you.
Okay, thank you very much. So the exam is the Advanced Diploma in International Taxation, which is run by the Chartered Institute of Taxation UK. Okay. So they have various international tax-related papers, and one of the relevant international tax papers that you can take is the transfer pricing paper. So it's like a specific certification for transfer pricing that you can get, and they actually issue certificates for just transfer pricing. So you don't have to have completed all the relevant papers to have the added qualification, that's the ADIT qualification. You can actually do the transfer pricing exam and get your certification. So that is actually it's a very detailed course, and it exposes you to a lot of issues in terms of transfer pricing, and that just helps you become more qualified and a relevant subject matter expert.
Okay, all right, thank you, Jazakumullah khairan. Yeah, so we'll come back to the hands we can see. So I'll call on Zinat Seriki to ask the question.
Assalamu alaikum warahmatullah. So my question is on a parent entity in the US financing a subsidiary in Nigeria. Is there any TP implications for that? So the parent company is doing equity investment in the Nigerian company. Is there any implication to that? Do we need to do any disclosure to FIRs regarding that transaction?
Okay, so regarding equity investments, it does not fall under the scope of transfer pricing. If there are other transactions, for example, maybe group overhead costs are being allocated or management services are being provided by the US parent entity to Nigeria. If there is additional investment in equity, then you would make an update to the existing declaration form, to notify the FIS that, okay, there is additional investment. But in terms of arm's length principle, it doesn't apply to equity investment, because equity investment does not affect profit or loss of the company in terms of taxes, and dividends is the return for shareholders and is not tax deductible. So it's paid after you unlike interest expense that is tax deductible, you don't get the benefit for dividends. So there's nothing to disclose from a related party transaction perspective for equity investments.
Okay, all right. Thank you for that straight to the point answer. I think there are a few more questions in the chat room. Number one, can you please expatiate more on definition of control and uncontrolled transactions in respect of TP? And then secondly, is there any threshold for TP transactions?
Okay, so starting with the second question. So for TP transactions, so if we look at for transaction by transaction basis, there's really no threshold. So if you receive services worth 500,000 naira from your parent entity, you still need to disclose it in the transfer pricing disclosure form and file. If your transaction value is 1 million naira, you still need to disclose. If it is $1 million, you still need to disclose it. So there's really no threshold. But where we apply discretion is if the transaction value is 500,000 naira and you want to prepare your TP. For example, let's say you have series of transactions. You have a lease arrangement with a related party. Maybe you leased a particular landed property on the mainland and you pay maybe 5 million per year for the lease, and you have other transactions and the total value of your transaction is over 300 million and you need to prepare TP documentation. You can use your discretion to say, for this lease arrangement that is 5 million, how do I establish that the lease renter is at arm's length? And if you determine that the only way you can do that is to engage maybe Jide Taiwo, for example, and the cost of engaging the Jide Taiwo is 10 million, common sense will tell you, I can't spend 10 million to justify that a 5 million transaction is at arm's length. So you can't, based on materiality threshold and from a common sense perspective, conclude that the transaction is low risk. So that's the leeway that the FRS sometimes grants taxpayers to say if the cost of establishing that the terms of the transaction is at arm's length is higher than the transaction value itself, then there's no point trying to test that transaction. But as a whole, if the totality of the related party transaction is less than 300 million naira, there is a partial exemption to say, okay, don't prepare TP documentation. However, from FIC's risk assessment, maybe from their DEX review, if they look at the TP forms that you filed, the TP disclosure form, they can then write to the company to prepare and submit TP documentation within 90 days. So there is a partial exemptions for those with transaction threshold of no more than less than 300 million naira.
Okay, all right. Thank you for that clarification. I don't see any hands up, but maybe a couple of questions. Will the transfer of the business assets to a friend of the MD assessment for loan be subject to TP? Will the transfer of a business asset to a friend of the MD assessment for loan be subject to TP?
It depends. A friend of the MD, if he owns a company, I don't think you can say there is a controlled transaction there because the friend is not related to the MD, and they are not under common control. But I think for CIT purposes, yes, the tax authorities would also look at it because it has implication. So the loan, is it a business loan? So is the MD loaning out money to the business of his friend, or is it for the friend's personal use? So the FIS will not focus on the friend as an individual if it's not for its own business. But FIS will look at the company of the MD to say, this loan, the interest expense, what are you making from it? So the FIS has the leeway to then, compute a notional interest and expect withholding tax. Or they may look at it from the perspective of, why should I calculate notional interest when I can allow you to just go and pay? Because if they compute notional interest, then Sorry, it's the other way around. Yes, they can compute notional interest. So if the friend has a company as well, and the director does not charge interest, that's when the FIS can let go, because they will look at it from the perspective of, if there is no interest expense, that will be deductible at 30%. Why should I compute notional interest to just take 10% withholding tax? So they look at it from a benefit perspective and say, let it go. But for TP, there is really no TP implication, but there could be a CIT implication depending on if it affects the tax base for the FIS's purposes.
Okay, all right, thank you. Sister Mo, 2 quick questions for you. Someone has requested that you also make your contact details available if they have further inquiries about the certification. But while you do that, can you also share with us, based on the question, what is the roadmap for someone who intends to pursue a career in TP strategy or TP advisory?
Okay. Is that for me or Busayo?
Let Busayo take that.
Okay.
All right, thank you very much. So for the first question, I believe that the organizers will share the contact person of the resource persons. So I think Mr. Rashida can get that from the organizers. So in terms of the opportunity to build a career in transfer pricing, well, the career in transfer pricing is going to be a subset of consulting services. That's, for me, I think that's the best place to start a career in transfer pricing, because when you're a consultant, you get exposed to a gamut of issues, of clients' issues, and you're given the opportunity to grow in the field. So when I say you're given the opportunity to grow in the field, what I mean is you start from an analyst to an experienced analyst to an associate. So there are different levels, and per level, there's an amount of knowledge or expertise that is expected. So if you go into a consulting firm, like maybe, for example, one of the big fours, your knowledge level as a first-year person, as an analyst, is expected to be 0 to nothing. I'm supposed to very minimal. Let me just put it that way. So if what you're expected to know is minimal, that means you're given the opportunity to learn and to grow. So it's like being paid for schooling or being paid to learn, because that's all you're expected to be doing. So as you get to your second year, a bit more responsibilities may be added to you, but trust me, you're still in your growth phase. When you get to your third year as an associate, you start to get more responsibilities. You may have the opportunity to start maybe leading smaller engagements or supporting your senior advisors and so on. So that helps you apply some of the knowledge that you built in your first and second year. So that way you start to also build your confidence to address clients' problems and issues with respect to transfer pricing. Then after your associate year, you become a senior advisor, and as a senior advisor, you're definitely expected to lead engagement. So as a senior advisor, you're like the middleman between management and non-management. So there are engagements that you will be the forerunner for. So you're the one going to the client's office, getting information, processing the information, preparing initial reports for your managers to review, and so on. And by the time you spend about 2 or 3 years doing that, definitely your hands would have been strengthened, your confidence level would have been built, and you'll be able to take on a role as a manager if you still decide to stay in consulting. And at that level too, we find people getting good offers, opportunities in industry as transfer pricing experts or specialists to work for various companies, both local and multinational companies. So once you've built that level of expertise over a 4-5 year period in a consulting environment, you can continue to grow on that path within the consulting environment, or you may decide to go to industry as a specialist. So for me, I would say if anyone wants to build expertise in transfer pricing, starting from a consulting firm will would be very beneficial. And of course, you know that it really doesn't matter what you study to a very large extent for you to be able to get an opportunity or an opening in a consulting firm. Once you're able to demonstrate the ability to learn, to grow, for example, you have your 2-1 and so on, to a very large extent, and you pass the relevant tests and interviews and so on, you'd most likely be given a seat in the room to demonstrate your ability to learn and grow over the years. And of course, getting the qualifications also, your ICANN, your ACCA, and in addition, the transfer pricing certification would also set you apart. So I would say that's the roadmap for me that, off the top of my head, that I would recommend would be to start from maybe consulting, so that you grow, you have the opportunity to face a lot of challenges, clients' issues that would help you strengthen your capacity as a transfer pricing specialist. I don't know if Gali also has other tips that he would want to add to that.
Okay, I think you said it all. Starting in consulting, it is a good way, because you'll be exposed to a lot of jobs across different sectors: oil and gas, financial services, consumer industrial market, and other subsectors. And you would also be able to work with those that have relevant experience to handhold you, share their own experience with you. For graduate trainees and experience, associates, they now do a lot of work as opposed to what we had before because of resource constraints. So skills and capability matrices are being reviewed to ensure that they also take up more responsibility. And my partner used to say that he can work with anybody. In fact, I have people at their 3rd year, they work directly with partners, and they are able to deliver, because he believes that once you've gone to the minimum requirement to be able to function is to go to university, get your degree, and come out to a minimum of 2. And once you have achieved that, he believes that you can work with him at that level, just to give instruction, guidance, direct you to resources, then expect you to deliver. And one way or the other, each and every one of us have prepared reports before graduating. So you did your research. And TP is similar to prepare. It's just as if you're preparing your final year reports all over again on each engagement, because you have your executive summary, you have to talk about the company, the group, you have to talk about the industry, which is similar to what you have as literature review. Then you have your hypothesis, and in the TP you state the related party transactions that you want to test. You talk extensively about the related transaction that you're testing. Then you conduct your research, and the research is the economic analysis in the report, where you do your benchmark. So in this instance, you won't ask people for responses, but you go into databases and obtain financial data of companies to analyze, and depending on your final year topics, I see people also obtain data, and they try to interpret it. And at the end of the day, you conclude whether or not those transactions were conducted at arm's length. So it's something that it's not too difficult to overcome. So you just be confident, do your research, read far and wide. You can always download the UN TP practical manual, which I mentioned that it's more explanatory. It has a lot of examples. So you read it, and those are the resources that you also rely on when you want to sit for your certification in transfer pricing. So there is a separate, the C, or Chartered Institute of Taxation of the UK, has a separate certificate for transfer pricing. So you can opt to only sit for the transfer pricing exam and get a certificate for that TP.
Okay. All right. Thank you very much for that detailed discussion. I thought I saw one hand up earlier. It has come down, unfortunately. I don't remember who that is. But want to thank our brother and our sister for all the, insights they have provided to us, the education, the training that they have given us. And I think even with the knowledge sources and with the certifications available that they have mentioned, I think the ball is in our court as individual professionals to then take it upon ourselves to go ahead and develop ourselves and add more value to our professional capacity. So I want to thank very much our brother Mr. Gali Aka and our sister Busaya Amon for sharing from their wealth of knowledge with us today. We pray that Almighty Allah subhanahu wa ta'ala will bless you. Allah subhanahu wa ta'ala will reward you for the knowledge that you have shared with us today. And Allah subhanahu wa ta'ala will continue to protect you and your family. Thank you very much. Thank you very much. So we'll now go back to the MC. We are supposed to have some short speech by ACAN representative, but I understand that there's nobody on the call right now. So I would like to call on Mr. Taiwo Kuye, or maybe before Mr. Taiwo Kuye, we might just want to take some few remarks before we close from some of our senior professional colleagues on the program. May I humbly call on River Past President and our father in the house, Alhaji Razak Jayola, to help us appreciate all our speakers and contributors today.
Thank you very much, Mr. Chairman and the Councillor. I must say I'm highly impressed at the standard of delivery. I'm not surprised anyway because I know some of the speakers. It's only Gali and Busayo that I've never met, and they have been very, very fantastic as far as I'm concerned. Like I said earlier on, I was driven to attend by the transfer pricing, to which I cannot even remember what it means at all, So I'm so happy that they have dealt with it thoroughly. Not only that, I do not have to go researching any other place again. Once I have this presentation and possibly the video, I'm done with the knowledge that I need in terms of marketing, transfer pricings, in terms of reviewing whatever my colleagues have done, and so on and so forth. So I very, very much deeply appreciate. I also want to appreciate the organizers. This type of program will draw more of our colleagues to the association, and I wish to support the association with 50,000 naira. Thank you very much.
Allah Akbar. Thank you very much, Father. Jazakumullah khairan. May Allah reward you for that show of support for the association. And I also like to use that opportunity to call on others to also, help us do the dawah about Mpaan. Tell your friends, tell your colleagues who are members of the Institute to come and join and also participate actively in the programs of the association. So thank you very much for that. At this juncture, I would like to hand over to the MC to then take us through the rest of the program. For myself, I'd like to very much thank all our resource persons here. I also like to thank all our members that have joined us from far and wide, make out time out of their busy schedule and on the weekend to come and share in this body of knowledge. May Allah subhanahu wa ta'ala make it useful for each and every one of us.
Amen.
Amen. Thank you. So MC, back to you.
Thank you. Made my work very, very light. Thank you to all the speakers. Thank you to our very calling. I never knew that council members are called councillors until today. So I've learned another thing this afternoon. So thank you very much, sir, for your time. It's not easy to get a partner's time for about 4 hours or thereabouts. Thank you, being with us in spirit and indeed embody. And last one, Allah bless you. We also want to thank our father, Alhaji Razak Jayola, past president. He's been with us way, way back. So the founding fathers of Mpaan. I remember while we were still, studying and we were still trying to pass the ICANN exams, he's been with us and backing us all the way, and he's still with us now. We thank you, sir. May Allah continue to grant you long life and grant you strong health. May Allah continue to bless your purse, which you have just donated from. May Allah continue to bless all your progenitors. I thank our facilitators, our speakers, our contributors, those who have asked questions, those who have joined this session online. I pray to Allah to continue to ease our path. Pray to Allah to continue to make us successful professionals. Professionals that Islam will be proud of, Muslim professionals that will be proud of, and we can always reach out to each other. We can always continue to share the glory of Islam. I hope that the slides will be shared to every one of us with the registered email address. And we also, like we've previously been doing, we also have ICANN MCPRs that will be allocated or allotted to every one of us who have attended the session. So we thank everyone for your contributions. Thank you. May Allah continue to ease our affairs and make us the best at what we do. Assalamu alaikum wa rahmatullahi wa barakatuh.
Wa alaikum assalam wa rahmatullahi wa barakatuh.
Wa alaikum assalam wa rahmatullahi wa barakatuh.
Are we going to have any? Okay.
Wa alaikum assalam wa rahmatullahi wa barakatuh.
Wa alaikum assalam wa rahmatullahi wa barakatuh. And inshallah, the next program coming up will be during Ramadan, our Ramadan seminar. May Allah spare each and every one of us life to be beyond then. Thank you so much, everyone.
All right, thank you.
Assalamu alaikum wa rahmatullahi wa barakatuh.
Jazakumullah khairan.
Wa alaikum salam wa rahmatullahi wa barakatuh.
Assalamu alaikum.
Alaikum salam wa rahmatullahi wa barakatuh.
Wa alaikum salam wa barakatuh. Jazakumullah khairan.
Wa alaikum salam wa rahmatullahi wa barakatuh. Jazakumullah khairan kaseeran.
I was not. Before I was talking about face to the argument. No,
Oh yeah, man.